Morning! Welcome back, trader friends. It's a bright and thankfully dry Thursday, this 3rd of October.
That was great. Looking out the window this morning, seeing if I need my brolly. No, not at all.
Now,
dry as we go. Not sure if it's meant to stay that way, but
yeah.
Now I don't have my umbrella, then I'm just going with it.
I've still got my raincoat. Like perpetually live with, in my raincoat from
That's
now.
it, risk and reward.
There you go. Yeah. Like, wasn't it the Scottish that came up with there's no such thing as bad weather?
The jocks we're going to call them today, because there is a reason for that, and that is very true, that there is no such thing as bad weather, just a poor choice of clothes, which is something that my girlfriend uses, as apparently it's a German saying as well.
Oh, there you go. Right.
Now, what have we got coming up this morning, Ange?
So we've got obviously overnight news first. We'll get you across all of that, and then we will have the opening bell. Overnight, plenty of news out there which we'll take you through, and then a little later in the day we'll have the one and only Ronnie Agnik from the trade desk.
Live from Trade Desk
Yes.
is Ronnie. Ronnie's back.
Yeah.
We've got a pretty good confirm and send coming up at 8:25, which is coming from a viewer in Kent. Matt from Kent. We are going to answer your question on hedging your FTSE position. So he's got a long-term FTSE position that he's had for a great number of years. I won't give away your age by telling people how many years, but he is looking to hedge it, as he thinks perhaps we're getting a little bit toppy coming into the end of the year. So hedging FTSE will be one of today's confirm and sends. Then we've got the Tom takeover. Tom Volsenholm is our trader expectations today. It's completely down to him. After me grilling him last week on PE ratios, Tom is taking control.
I heard
of trade expectations.
He's still recovering from that unexpected
the Jenga tower going down.
Tower going down.
It's that's my favourite moment of the week so far. Please have a look back on Tuesday, about halfway through the show, and you'll see Tom's face. We might try and get a replay of that actually, as I knocked over the full PE ratio tower.
It's priceless actually. He's kind of like.
And then finally, did anybody have Super Micro for the stock split a couple of days ago? So Super Micro, 10-for-1 stock split. In market measures, Sahil has looked at, does a stock split ever create value on a stock, or does it help the stock outperform the general market? So market measures, they're looking at stock splits.
That's super useful because we've had quite a few stock splits, haven't we?
It's been a big year for them actually, in the big names as well. Of course, Nvidia.
Yeah, Nvidia's the big one.
Yeah, Deckers, my hawker, which a well-known broker in the UK forgot to do the stock split on my shares. It was only 4 days later that you actually saw the shares come into my account. So it looked like I was down 80%. So yeah, I won't mention who they are, but that. Do you remember that that wonderful Irish rugby stadium called Lansdowne Road? Yeah, but yeah, that's got nothing to do with the name of the broker.
We also had Tesla, right?
Yeah.
Is that right? 3-for-1 stock split?
Was that this year? So I guess we are in October already,
Producer
aren't we?
Fred is calling out saying also Walmart.
A Walmart 3-for-1 as well. It has been we generally, I guess, as we see the market at all-time highs, then CEOs are going to take the chance of splitting their stock. Makes sense. How was your evening, Ange?
It was really good. I was pleased to see that the stocks that I called out yesterday did have quite a lot of movement. The Nvidia and Tesla as well. For those of you that trade Tesla, not so good news. I am watching to see how the reaction is all sessions again today, but it did get a punch in the stomach with the deliveries, right?
Yeah.
But that is also bedded in the backward-looking numbers. I'm kind of watching to see if there's any sort of reaction to the China Tuesday, because obviously China is their biggest market, I didn't get up too much yesterday. I think yesterday was kind of like a recoup, watch a bit of Netflix.
I watched the first episode of Industry and the second episode. The first episode, this is of course the series about almost like a fly on the wall drama series of an investment bank in the UK called Pierpoint. Not quite sure exactly which one. I think they've taken ideas from all kinds of trading floors, but it's so realistic.
Is it?
It's incredible. They do really well.
Do I need to watch it at the weekend, Rich, whereby I can like binge watch, or is it something I can watch, in small chunks?
There's now 3 series,
Oh,
so by all means, binge away, but it will take up your whole weekend.
Okay.
Yeah, and if it's addictive because you'll recognise the stories. You'll probably have reported on many of the stories. But this is the start of the 3rd series, and it's I really highly recommend it. They're talking about an IPO, and this IPO coming onto the UK market, and it's slightly controversial, and it took me back. I actually had a nightmare last night about Glencore, because I IPO'd Glencore back in 2011, May the 11th, imprinted on my mind, and we got absolutely hosed. We got killed. Stock opened at 5.49 coming out of the auction, and then closed at 5.30 on day 1. We stabilised it, and then day 2, boom, right through the stabilisation.
Is that why you don't like IPOs? Is that why you tend to kind of steer clear of IPO?
I think,
IPOs?
what are we, 13 years later, I think I've finally managed to get back into the IPO market. But
the gallery guys are letting us know that our viewers are, by the way, this is not planned whatsoever. I mean, if anything, like the tops, producer Fred saying that we've got some viewers asking why we've got matching tops.
I see, yeah, we do have.
Me,
We've got the comment section open.
He had a jumper on.
Not sponsored at all, but yeah, look at that. There was no planning for that, and this is the 2nd time that it's happened actually.
I know, this is insane.
But yeah, if you're watching on YouTube, we do have the comments section open. Is it that way, producer Fred? Is that right?
Is that
other way? That way. So we've got a nice amount of comments in there already. Good morning, Isar. Good morning to the monkey. To the monkey man. I do believe that's one of my TikTok guys coming on. He's had a great couple of trades on there. So yeah, drop us a comment, and you can also ask your questions in there. We've got the email address as well, ask@ig.com. Really got to get used to my bearings here. But
loving the questions coming through as well, the answers to like previous days' questions, which I've been getting. Like someone said, the answer to the quiz question was a rubber band and
the blocks, yeah.
Yes.
Yeah.
But the thing that was quite funny is I also got comments like it was like blocks and a hairpin. Or like I don't know what you guys watching, like which other channel is doing this? Like I don't understand. But
there are no other channels out there.
There are no other channels. This is the only traders channel out there. It's the only one. So don't know which channel you're watching. But overnight stories really cool as well. The one that I flagged yesterday, and Rich has been flagging as well in the previous session, is this U.S. port strike.
Well, that seems like the perfect opportunity to go on to overnight action.
Hey guys, welcome back, and let's get you across the overnight action. Rich and I were just talking about the port strikes. Incredible.
Yeah, it's actually gone ahead. I missed this one. Too busy watching Industry, clearly.
Industry. I was just speaking to a friend in the US about how this might impact banana prices, because almost all the bananas eaten by Americans comes through Port Wilmington in Delaware.
Right.
And it is, impact. I mean, this is big news, right? I mean, this is like the biggest.
Yeah, they're talking about food prices, apparel prices, basically anything that comes in to the East Coast, autos as well. It's really going to potentially have an effect on the prices going into holiday season.
I know, right? Home Depot, LG, tons of names out there. There's also been news out from the likes of Walmart to say that they were worried about the situation. They'd already sort of front-ended and shipped things in early.
Mm-hmm. Yeah.
But it is going to be huge, given this comes on top of strikes at Boeing, as we know, and it remains to be seen. We're just looking out for any sort of huge reaction, and our client managers asking the question today: which company is most impacted by U.S. port strikes? So, trader friends.
Ooh, interesting.
Yeah, if you'd like a chance at winning that quiz, do message in or type it in the YouTube chat. Which companies, 3, most impacted by US port strikes?
3 companies. Okay, great. Right, what did we see overnight then? Well, it was a little bit of reversal from Monday. So remember, Monday we saw a continuation, or Monday and Tuesday I should say, continuation of the strength in China, and then we had Japan sell off on Monday. Well, overnight Japan was up 2%, and we saw the Hang Seng give back 3%. So there we go, there's the overnights. And the reason that Japan has bounced, and we've seen a sell-off in the yen as well, actually one of the biggest sell-off in the yen that we've seen in a long time, was because the new Prime Minister Ishiba said that Japan was not in the environment for additional rate hikes. Not in the environment for additional rate hikes. That's, of course, Ishiba. He's trying to shake off this idea the market had of him as that result came through on Friday, that he was a hawk, a monetary policy hawk. So dovish comments overnight, seeing the Japanese equities go up and the Japanese yen go down. So we're 146 we're trading at now on the yen.
Interesting, the Nikkei is moving back towards the July high, which and also the 27th of September high. So that's quite a strong resistance level there, because not only did it touch in September, but it also touched back in July and also beginning of July. So at the moment, interesting to watch if it crosses that line and if we see a breakout.
Definitely. And then conversely, on the yen, we see that we've had this the strengthening of the yen. Remember, it's tricky with dollar yen because this is actually a strengthening when the chart is going down, right? So that's weakness in the dollar relative to the yen. But you see that we touched new lows there. When was this? This would have been about 2 weeks ago. Then we had the result come through here of the Prime Minister Ishiba winning, and now we see that snapback. So we're actually now above 146, almost touch 147 overnight. So that, I would say that's kind of Goldilocks area, right? You're not going to get too, it's not going to interfere, if you like, with risk appetite elsewhere in the world. I would have been worried if we had gone through that 140 level. That would have started to give me concern again. But anywhere between 145 and 150 seems to be Goldilocks for now.
Also, Chinese mainland markets still closed for a holiday. A mate of mine in Germany said it's also closed there for some public holiday. Is that right? Does your girlfriend?
It's the anniversary of the reunification. So big day in Germany in the history, recent history. Okay, we've had a trading statement from Tesco this morning. All right, Tesco.
First half adjusted operating profit surpassing estimates. So that's a key one to look out for when the market opens shortly.
and raising guidance there as well. The comment being, and thank you to Mike for sending in the exact comment we're looking for. Significant investments we're making in value, quality and service across the group have delivered volume growth ahead of our expectations in the first half. That is me moving on to those club card points.
I'm telling you, Tesco is still the best for if you want your delivery on time. There's still
the quality of the service it really has been impressive. So due to this strong performance, we now expect to deliver around 2.9 billion sterling adjusted operating profit for the 24-25 financial year, and that was previously 2.8. So yeah, it's a small increase, 100 million sterling worth, but just perhaps the dividend not quite living up to hopes. So one to watch this morning. Stock closed at 354 yesterday.
British Land, one that I am looking out for as well before cable, because British Land also had some guidance, I believe. And Rich is also going to talk about some cable and sterling in a moment. But if you come off my chart for a bit, what's key about British Land is that it's announced this new retail park acquisition and has confirmed its full year 2025 guidance. So watching that early on.
And just on that, I think there was a bit of a placing last night in British Land. Let me just confirm that. Yeah, Hargreaves Lansdowne, not the company I was talking about earlier, of course, doing a retail British Land placing. So that closed at 7:30 last night. So let's see how that opens this morning. But yeah, first time I've heard of a decent sized retail placing there.
You hold LV, don't you?
Not anymore. No, that was me buying it for the bounce, and it was a pawn position, low conviction for the bounce.
Well, LVMH, as you have cleared the decks on that one, you might want to relook at it, because LVMH and Formula One have announced a 10-year partnership.
Oh, that is the curse, though.
Yeah.
Any car, the amount of when the brand's been on the car that have subsequently, So most recently, I think it was FTX.
Ah, yes.
Obviously Credit Suisse.
Petronas, the oil major of Malaysia, has been on for ages, right?
Right, and it's successfully. I think Bear Stearns was on there. I think Lehman's was on there. You've had a real run of things.
Right, so taking a look at cable, because cable, producer Fred saying that there's quite a lot of movement on cable.
Well, this was after yesterday. So Andrew Bailey was suggesting more aggressive rate cuts in the UK. So that was a move, British pound down approximately 0.5% against the euro and US dollar. That was, specifically a move in GBP. That was largely due to those comments from Andrew Bailey yesterday. Of course, we did mention that this peaked as Powell was speaking on Tuesday evening, right? That was your opportunity to get short this thing, because Powell made it very clear that the Fed was only going to cut by 25 basis points if the data came out as they expected in the next 5 weeks. And that was cable trading 133.70, since sold off, now trading 131.80. So that's that's been the trade of the week for me, I think, because it was right at that level, 134. It was very vulnerable, let's say, to a sell-off, and we certainly have had that.
I've also cleared the decks on cable, hoping to go back in again, but after that jobs number on Friday. And then we've got a lot of UK data out in the coming week as well. So once that mood music is clear, then perhaps going back into cable with a more sort of longer term position and a medium term position, as we we're in the countdown to the elections now, right?
That's right. Yeah, it's going to be a really, we are within a month today. No, today's the 3rd, isn't it? So we're almost there. 32-day countdown to that election. In the meantime, we've got 2 big jobs numbers coming out. So of course, Friday, the big non-farm. You're going to see unemployment. You're going to see wage growth, and then before then today, we have the ISM Services PMI.
That's right, at 1500 London time, and also at 1540 we've got speeches from Feds Bostic and Kashkari. Just a few BMW, one to watch, just a few updates ahead of the open. We're 10 minutes away. BMW upgraded rather to equal weight at Barclays. The price target, if you whack up BMW, set at around 80, I believe.
They've really called that well. Then, if that's them upgrading from, I guess, underweight, then that's been a great shout. Let's look at that over the longer term. Look at that! What a fantastic shout that's been from Jefferies. So raising to neutral with the, did they say a price target?
Price target set at 80.
80, right, so right there. So that's the kind of call I like. I hate when analysts have got ratings of neutral and there's 20% upside.
Yeah.
It's always so absurd when they do that. But we got so only seeing 4% upside.
Imperial
there.
Brands, also another move there in terms of broker ratings. Imperial Brands upgraded to overweight at Morgan Stanley.
Oh, that's an interesting one.
Not one I normally trade, I have to say.
Do you trade bats at all?
Yes, for my sins. I do trade bats just because I watch with fascination the change from, cigarettes are everywhere. In Formula One, they remember when they used to give away umbrellas and you could use merch, right? My dad's a big advertising guy. I've been told he's a bit like the people in Mad Men, but I also must never watch that series because I've been told that I'll have pizza in my hair, I'll be addicted to it, and then there'll be the end. I won't show up for the show. When Rich is here, he'll be on his own. So, but they've had to really revolutionize. I mean, it must have been so painful and still painful inside, along with Philip Morris and all the others, to a beyond just tobacco. So that's a great shorting opportunity throughout that time too. But they've been upgraded.
You can see the effect there on my screen of the ESG effect, right? This was probably a 4-year period of just a huge sell-off in the tobacco sector. Imperial Brands is one of my favorite stocks, not because of what it is now, but the easiest ever profit in 2008. So the company, there was a placing from I think it was JP Morgan back in 2008, and they couldn't fill the book. So it was like one of those industry episodes, right? They couldn't fill the book, so the stock was down something like 15% on the day, and they kept on bringing the price down, and then we managed to get some, almost a clean-up trade, as you say, at into the close, and it was up 15% within a week.
Yeah,
fantastic.
Cool. And on that note, we are going to the break, and we'll be back with the opening bell.
Hi, I'm Sean Murison, Senior Market Analyst at IG, and join us for our new show, Charting Essentials. That's every fortnight on IG.com, our trading platform, as well as YouTube. And that's a show where we look at everything technical analysis, hoping to help you upskill, whether you're starting out or just looking to level up. We got you covered. In each episode, we'll break down complex concepts into easy to understand lessons, provide practical tips to help you sharpen your chart reading abilities, explore powerful technical indicators in real-world applications, as well as guide you to hands-on examples to reinforce your learning. So come, let's work on our skills. Let's get better at this. Let's accelerate that trading journey, learn to have confidence to trade, and make informed trading decisions.
Welcome to IG's Charting the Markets, your gateway to expert technical analysis and market forecasts. Our video series breaks down the complex world of technical analysis into three key asset classes: indices, forex, and commodities. Watch as IG's expert analysts dissect charts, spot trends, and provide actionable insights. Whether you're tracking global indices, navigating currency pairs, or exploring commodity markets, we've got you covered. Sharpen your technical analysis skills and make informed decisions. Join us for Charting the Markets every week in IG's trading platform and on IG.com, where data meets clarity. Start watching now and stay ahead of the curve.
Fundamental analysis is a method of evaluating assets to assess what their prices should be. It's based on the principle that every asset has a real fair value, which may be very different to its current price. It assumes that markets will naturally correct to reflect these fair values over time. The aim is to discover assets that are currently underpriced or overpriced, then place trades to profit from the expected correction if it materializes. Now, unlike a technical analysis that focuses on price charts, a detailed fundamental analysis would look at everything that could drive future price movements. The technique is most commonly used to scrutinize the price of shares, where annual reports, industry trends, and a company's management team may form part of an overall assessment. However, fundamental analysis can be used to review the price of an asset. A commodity like oil, for example, could be evaluated on the basis of economic data, regulation, brand recognition, geopolitical factors, and technical specification, among other factors. But while fundamental analysis is often said to be more comprehensive than technical analysis, it may not give you the full picture. For one thing, it's generally only useful for identifying long-term trends, whereas a technical analysis can help find short-term opportunities. For this reason, it's often a good idea to combine elements of both types to get the most accurate view of a market's direction. To learn more about fundamental analysis, join IG Academy today. It's completely free and gives you access to dozens of trading topics.
Welcome back, people. It's the opening bell. Rich, what we got?
And we've got some with this fantastic email that the PCM desk send out every morning. Early indications. BAT's down 2%. So as well as the Imperial brand upgrade, Morgan Stanley have downgraded British American Tobacco. So what's that one down? 2%. Price target £25. British Land expected to be down 2% on the placing last night. That was 69.5 million shares at 422. So British Land there was a placing last night. National Grid cut to neutral at Citigroup. Remember, that was the big refinancing that they did with the rights issue earlier on the year. Been one of the biggest bounces since. Really fantastic bounce there. And National Grid, I think it touched £8 at one point. SSE unchanged on the renewables performance being in line, and Tesco, where you get your best close, is looking up 2% as indicated there. Just a quick run through the ex-dividends as well. Don't worry if you see these stocks down. Smith & Nephew.
Yeah, don't call the PCMs going, why is my stock down? Okay.
Looks like about 14 cents on Smith & Nephew. Centrica, 1.5 pennies. And the Weir Group, 18 pence.
Aston Martin is one to watch this morning. We're now 8 o'clock, so full steam ahead here. Aston Martin Lagonda, take a look at that. I have said many times that this is look at that chart. This is the 3-minute chart, and take a look at that action. I mean, you know, where is the bottom, Rich? Where is the bottom in the stock? It's just one of those that just keeps on giving, you know, bad news over and moves lower just when you think it can't possibly move any lower. That's the 3-minute chart for you. But if you look at the weekly chart, there you go. Look at that stock.
There's only one investment you should do in Aston Martin, and that's buying the car.
I thought you said it was a DB no.
Oh, my DBS. But, yeah, I'll give you the DB7, or for the classic lovers. Now,
taking a look
FTSE, SSE taking the results well. It had sold off previously, so up 1.4%. So that's the best performer in the FTSE so far. HSBC up 1%. Shell extending its gains from yesterday. Shell up 1%. JD Sports bouncing after those poor results yesterday, also up 1%. Where do we have Tesco? Tesco down 20 basis points. Little bit of nothingness.
Marks and Spencer, Tom W's favourite stock there, up 0.5%.
And what about the losers today? Do we have any effect on that sell-off in China? Burberry down 1%, so clearly trading with the Hang Seng. And BAT's down 1% on that placing last night.
Okay, cool. Also, with Germany's obviously on holiday, France, let's take a look at the CAC 40, France 40 on the platform. The biggest gainers there, Total Energies, DCC, I don't know why that's there. Thales and Safran and Engie, is that how I say it, Fred?
It is, that's perfect.
There you go. Carrefour are also slightly higher, but let's take a look at the losers on the France 40. Stellantis is down, EssilorLuxottica as well. Renault down almost 1%, and LVMH, luckily you're out of that now, Rich, down 2/3%. So it's looking more.
Yeah, so we've got the German names trading. It's just that it's a public holiday in Germany, but not a bank holiday.
Oh, it's not a bank holiday.
Not a bank holiday. So yeah, my girlfriend's having to work, even though she is in Milan, living it up anyway in the Milan office.
Nice.
She's having to work today. So we see those.
Let's have a look at those then.
German autos. Porsche, the Porsche SE is the biggest loser, down 1.3. Mercedes-Benz giving up also the same, and BMW with that neutral increase to neutral, it's only down 60 basis points. So a slight outperformance there on the back of a Jefferies upgrade.
I think BMW too is coming off because they had a bit of a lift from China, right?
That's exactly right. Yeah.
So many of the car makers had a bit of a lift there. Boy, do they love their BMWs and their Mercedes-Benz, which they call Tai Saiyan in Hong Kong, which just means big small eyes for the front of the car because it has
very good.
Big small eyes, Tai Saiyan. But across Germany 40, we've also got Daimler Truck, the biggest gainer, 2.7%. Rheinmetall still up there amongst the top 3.
It is, isn't it?
Yeah, and we've got also Hannover Re and Bayer as well. So it looks overall to be quite a mixed day, really. FTSE is up, and we've got a question from Matt in Kent later on, don't we?
That's right, yeah, how to hedge. If you think the FTSE is getting close to the top of its range, how do we hedge that exposure? So that's going to be coming up in our next section in about 15 minutes' time. Shall we have a look at our good friends, the commodities?
Yeah, love a bit commodities.
So, yeah, we still got those, oil around the Middle East. There was a big build in inventories yesterday, though. So you did see oil sell off from 71.5 right down to 70 on the back of a big, much bigger than expected build in inventories. However, that is regaining some of its steam now. So back above $71 WTI, Brent approaching 75.
I'm going to take a bit of a nibble on WTI, and I'm going to buy, and I'm going to set my stop. What else are you looking at, Rich, whilst I'm placing
That is, you're brave.
Am I?
I like your bravery because I don't think I ever make money. The only time I've made money in oil was by selling puts, and that was on the view that the US government would obviously come back in to replenish their strategic reserve, right? So it's at 75, I'll sell the 60 puts, right? So pretty wimpy, allowing it to have a 20% fall before I start getting hit on those puts. But, actually trading it here,
Deal confirmed. I pressed it before Rich could talk me out of it.
yeah.
But we'll do it.
But that's it. With that tight stop that you've put on.
There's a tight stop, and also I'll do a pair trade after this to do with the airlines, because that's quite a nice pair, right?
Yeah.
Always think about your risk appetite and have your guardrails in place so that you can sleep at night. Yeah.
Elsewhere, commodity land, we got the precious metals slightly lower, 26.53. You've got a bit of a two-way pool in gold, I feel, at the moment, or the precious metals as a whole from monetary policy. You've got the chances are the market's priced in way too much on the Fed rate cuts, whereas Bailey in the UK talking about more rate cuts now, right? So that's why GBP is lower overnight. And you got a two-way pool in gold because, of course, one of the beneficiaries from easy monetary policy is gold, because the converse of fiat, not the cars, fiat currency. Obviously, as we get easy monetary policy, the chances are we'll see more inflation and the relative value of fiat will drop. Copper, not really doing much. That's near the top of its recent range, isn't it, Ange?
It is. Interesting. Well, it's healthy to see the market take a breath, right? Because we had the China effect, and no one wants to see traders themselves get alarmed if you keep seeing higher highs for consecutive days.
Yeah.
So I think this is just something that's quite healthy for the market. Interesting there that there is behind your cursor. Is that a gap? No, it's not a gap. I quite like gaps. Look out for gaps.
Yeah, there's not really any there on the daily chart just yet. So so it did have that sort of, for about 2 hours it popped up to $473, but we're looking back down now. And this is, of course, the HGA copper, right? Not the LME. LME, similar chart, obviously, it's the same thing, but it does trade slightly differently on the LME. That'll be back above 10,000, I think.
If there's a breakout past that level, then you'd have 3 crosses, won't you? Or 4 even, so that's a very strong.
So take a look at the LME, there you go, to prove your point on the...
Yeah.
Add to workspace, and that's interesting, isn't it?
Yeah. So that would be quite a strong. If you see a breakout at that level, you've already had 3 prior to that, so that would be a strong, signal. A strong, if it breaks, confidently above that level.
And above the top of the candle, or?
Or rather, the shadow is, the shadow. Yes, above.
Okay.
Yeah.
So 10,480
Yeah.
would be a very interesting breakout, and it is where I think copper is going in the longer term. I'm just not sure about the short term because, if we don't go into a recession, then my goodness, does this thing go into a deficit, a demand-supply deficit over the coming years. There's numerous banks, have been talking about this for years now, and if we remember, copper goes into electric vehicles, copper goes into data centers, copper goes into, into China, so the Chinese economy. This thing, it's really one to watch over the next few years because the investment just hasn't gone into the mining.
And also what's really interesting is that you mentioned that R word. Recently, Rich, we've been hearing this sudden trickle in of this recession fear word, right? I mean, what's your view? Do you think we're actually at risk? I mean, of now that JP's, fired the shot across the bows, do you think we are at risk? I remember everyone talking about this R word a year ago, and then it became, what risk? It's and that got kicked back. Now it's kind of in the forefront again. We do have. I was talking to quite a few analysts yesterday. We do have a convergence, a confluence of some worrying factors, right?
Right.
One is this port strike with 45,000 dock workers. That's 45,000 dock workers that are striking and halting shipments at the US East Coast and Gulf.
With a cost of $5 billion per day on the economy.
Yeah, and apparently that's a medium estimate, right?
Right.
So,
right.
But also we've got what's happening in the Middle East. We also have, China on the other hand is, giving that bazooka shot in the arm.
Yeah.
So, do you think there's a real risk of recession?
So I think the reason people were worried about it, and they were right to be worried about it, is because of, historically speaking, we should be in recession by now, right? However, the time lags are impossible to judge this time because everybody refinanced in 2020 and 2021 when rates were zero, right? So you had a lot of the need for debt was satisfied then. Now, monetary policy becomes pretty much impotent if you don't have anybody that needs to refinance. So therefore, you didn't have any control over, reining in people's spending in 2023 and so far this year. However, when that time lag hits, then there's a chance that it really hits hard. And unemployment growing at the same time as people start to have to refinance, that is when you're going to see, a real, and I think that's what Powell's worried about. I think that's why we saw this recalibration of the 50 basis point cut a few weeks ago. And it's impossible to tell now. We could be on the precipice of a significant slowdown. Mm-hmm. And the question is there a time lag from when he cuts rates? There should be, because there's definitely been a time lag from when he raised rates. So is there the same time lag when he's going to cut and try and stimulate? Or is China doing the work for him?
Yeah. I think there was a sigh of relief, right, when China did what it did. And I think at the Fed, there was also a sort of, thank goodness they've done it. Right?
There is, but at the same time, there's the real concern around the debt situation in China. How do they fund this huge stimulus?
They just print more money. That's all they'll do. They just print more money.
Yeah, but that has consequences,
yes.
Right? Everything. The monetary policy for the last 15 years has been about doing everything they can, and then you deal with the consequences when those consequences happen, right? And you deal with it by potentially printing more money, or Operation Twist, or government stimulus. We're getting to the point now in the next few years where the government can't just run any budget deficit that it wants. Liz Truss found that out, right? She was punished and the pound was punished, and UK mortgage holders were punished. So do we have that moment once we get a new president, you know, in the next 12 to 18 months, do we see the same moment in the US? Concerns around the dollar. Producer Fred was highlighting some research this morning about concerns around the dollar over the coming 12 months.
Totally. I can tell you that services are really expensive there. Shout out to those of you that want to find this space as fascinating as we do. When Money Dies is a book that is by Ferguson. Really interesting. He talks about, you know, what happens when governments print money. Weimar Republic, which preceded, which preceded what is, well, now we know as the, you know, the Nazis and how it started. But he delves back. What's interesting is he delves back to the diaries of when, at the very beginning, during the Weimar Republic, people would come and, you know, they'd ask for payment for goods delivered, and you'd pay a certain amount, and by the next week they'd come and they'll say, well, that's not the price anymore, but we'll have that grand piano that's behind you, or you know, that painting that's behind you, we'll have that as payment instead.
Wow. So
it's a great book, great read, really, really tiny. Speaking of inflation, this port strike could really raise prices, especially bananas. And I've just got a really...
we got a comment on it, didn't we?
Yeah, it's saying, you know, may impact the US, but not going to impact bananas in the UK, where we have a massive stockpile on Bradford ready to be ripened on demand. And yes, you're right, because the bananas here that we get at IG, show them, Rich, are very green. Yeah.
Free bananas every morning, which I am very, thanks to Maria for those.
We have an interesting question too from Monkey Man. Thank you so much for sending that in, because I am awaiting the 10th of October with great excitement, because I trade Tesla, and this is something that I watch. If you Google my name and under RoboTaxi, you'll find stuff that I've written for IG prior to this. I think there's a lot of hype surrounding the RoboTaxi, and because there's been so much hype, I think it's going to be a bit of a head fake situation for the shares if you're asking about price action. I've got Tesla up here, and as you can see, that fall was because of the disappointment surrounding the deliveries. What you must remember is that RoboTaxis, have you ever been in one, Rich?
I have not, no.
Many people here find it a strange concept, but actually they are already easily and widely available in places like San Francisco and some parts of China. There's some parts of China where there is a huge rollout, and it's pretty much every taxi that you get into. They might still have to have a person sat in the taxi with you just for health and safety purposes. But they're not doing anything. They're just making sure the RoboTaxi is doing what it should. So this is why I think that it is going to be a bit of a head fake, because we've had so much hype, right? We've had so much hype over this technology for ages and ages and ages. Just like when, do you remember the time, Monkey Man, when microwave still came out, and all these things about how don't stand in front of it, you're going to get irradiated. And then your grandma or your granddad saying, don't put your hand on the microwave when you're in a halls of residences. Or
still don't trust them.
You one of those or no microwave?
I don't use microwaves. No.
Really? No.
True fact. My mother thinks I'm crazy. Yeah.
How do you, I think you're crazy. How do you warm anything up?
In the oven, how it's meant to be. So on the, we've had some really interesting comments on the YouTube this morning. And KBL1, tell us your name so we can give you a proper shout out, pointing out that UK rate futures point to about 42 basis points of cuts to the bank rate in the remainder of this year, right? And that was versus 36 yesterday. So yeah, a move towards 2 cuts or a 50 basis point cut. And obviously that is much dependent on the price of oil. And what's going on in the Middle East there.
Yeah, and also we're having to go to break soon. I'm losing my voice already. It's not only Thursday, but keep an eye on obviously the indices as we get closer to the Wall Street Open. S&P 500 posting 27 new 52-week highs and 2 new lows, and the Nasdaq recording 80 new highs and 133 new lows.
Let's take a quick look at the FTSE names there, because we've had a big mover, right? Remember, Tesco opened unchanged and now it's up 2.3%, right? The funds are coming in for it. They're coming in for this thing.
Is this after
to
the
buy it.
PMM, the post-morning meeting?
It's a bit early for that yet, so that's really interesting that it opened unch and it's now up 2.3, and then SSE as well, up 1.3 on numbers. So that's the two movers there. Did we have a reaction in British land? Down 1.4.
Yeah, it's not as large as I expected, I have to say.
Yeah, so the placing done last night. Let's see if I can get that price. But yeah, down 1.3.
Yeah.
Interesting one.
Yeah.
To watch this morning.
Right, we have to get to break now, trader friends. So we'll be right back. Stay with us because we're going to have Confirm and Send. Welcome back, welcome back. This is our favorite segment, isn't it? Confirm and Send.
It is, and especially on the first question we have this morning, because it's very similar to the view I have currently myself. Let's go straight to it. So what options trade could I put on to hedge my iShares FTSE 100 ETF? All right, so this is somebody that has been long. This is Matt from Kent. Thank you very much for your question, Matt. Matt's been long the FTSE 100 for a long time, right? And now it's getting to the point, maybe towards year end, where it's had a really nice increase, right? It's had a nice run, the FTSE 100, and he's looking to hedge just in case we see some downside into the end of the year. How do we do this on the IG app? Well, let's look at the screen there if we can, and we simply go to options. So on your sidebar here, choose options, right? And then look for your FTSE 100 and give it a click on there. And if we are talking about year end, let's look at December. Okay, now what does this, and this is what scares some people off, right? So let's go through what exactly this screen means. At the top, we have the month of expiry, right? December 2024. Then we have the price, the current price of the FTSE. Then we go on to the strikes. So that middle column is the strikes. And this helpful white line tells you exactly where the index is at the moment to the nearest 25 points. So that's what we call at the money. All right. Now that's where Matt's FTSE ETF will be trading in relative to the index, right? So that's at the money. On the left-hand side, we've got calls. Now, calls are always shown on the left and puts are always shown on the right. So think of this is what you trade for the stock or the index going higher, and this is what you trade looking at the downside, right? If you're focused on the downside. Then remember, you can buy or sell each of those instruments. So calls, you can buy if you think the index is going to go up, or calls you can sell if you don't think the index is going to go up. You might think it's neutral, or you think it might go down. Now, the other time you might sell a call is if you own the underlying, and that's what situation we are in at the moment. Matt owns the FTSE 100 ETF, but thinks the upside might be limited, doesn't want to sell his ETF. Okay, so what we can potentially do is cap the upside. Now, this is called a covered call. So what we're going to do is we're going to cap the upside at 8,600, so 250 points higher, right? So that's 3%. So what we're saying is, Matt, look, enjoy the next 3%, right? You've got that for free. And then we're capping your upside from there. If we sell this option here, you're going to receive 66 points of the FTSE, right? So that, I think, it works out about 0.7% roughly. So about 70 basis points. Now, if that was all you were going to do, then remember your break even is therefore 8,667, right? So you would benefit on your ETF all the way up to 8,667 before losing any money. If it doesn't get up as high as that by December expiry, then you just receive the 67. So almost in a perfect world, the FTSE would go up to 8,600, right? And you'd benefit, your ETF would benefit from that, but you'd also receive that 67 points there of income. Now, what's an alternative if you didn't just think the FTSE was going to stop going up? What if you think it's going to go down, Angeline?
Then you can go over to the put side.
Excellent.
And do the reverse, really.
So remember you've taken in 67 points there. Let's go and take that 67 points and let's spend it on downside protection.
Can you zoom in for our trader friends? Zoom in onto that section, yeah, so that it's a bit closer. Brilliant.
There we go. Right, now we're currently trading at 8,350. Let's say Matt doesn't really mind if it goes down, 2%, right? Or even 3%. So the index at December expiry is trading at 8,100. However, he does not want to give away any more of his gains after that. So he buys a put for 103 ticks, right? Now remember, you've had that income of 67 points from giving away the upside. So you've got 67 in your pocket to spend. So you spend all of that on this downside, right? And that's another, 26 points on top? Is that right? 67 minus 100? No, 36. 36 points you'd have to pay, right? Now, what if you think the FTSE goes down, but it doesn't go down that much, right? It doesn't go down beyond, down another 10% after that. Well, in that case, you can cap your downside, right? So the protection, you could receive 20 points for then selling a 7,300, and you turn that into a put spread. So remember, you've bought this 8,100, you've paid out 102, and then you're protected all the way down until the 7,300 level. But you say, do you know what, I don't think it's going to go down to that low. That means you're paying 103, but you're receiving 21, basically. And you've also received 67, remember. So that's, your receipts are 67 plus 21, which is 88, and you've paid out 103. So therefore, the total cost of doing this is only 15 ticks, which is nothing. It's 20 basis points, 0.2% of the FTSE. So a reminder, you would sell one of the 8600s to cap your upside. Then you buy your protection at 8,100, and you sell the same number at 7,300. So that's net cost of hardly anything, and that would be your position covered for a 13% move lower for 0.2%.
That's
right?
basically free insurance.
It's free insurance by capping your upside. Just remember, if your ETF is not with on your IG position, you will have a P&L happen. So you need to have enough capital in there, right, just in case the FTSE goes up 10%, and you're winning wherever the ETF is, you get the profit, but you would have a loss associated with your options position. So you just remember to have the right amount of capital there. But yeah, that's those are the trades that I love, because I'm not especially bullish on especially the S&P 500 at the moment. I'm a little bit more optimistic on the FTSE 100, but that's because I think GBP will drop. Anyway.
I don't trade the FTSE. I'm very much a S&P 500, NASDAQ sort of person.
And
that's good. That's good.
Exactly.
You've got a hedge there, really.
And the same theory, certainly works on the US 500 as well. We've got December options available on the IG platform for the S&P 500. So I think that answers that one, Matt. Any more follow-up questions, please don't hesitate to send them in. ask@ig.com, and we'll go on to question 2.
Can you explain how spread betting differs from traditional trading? Right, so a broad overview is that with traditional trading, right, Rich, the basic premise is you buy and take ownership of the shares, whereas with spread betting, you can speculate on the price movements without taking ownership of the shares. In traditional trading, you the premise is you buy it in the hope of the price going higher. Mm-hmm. But with spread betting, you can decide to bet on it going higher or lower, which is a key feature.
So you can short as well.
Exactly.
Right.
Because there are times, right, like with the robo-taxi, you think there's going to be a head fake or bad news. Nike changing its CEO and the former CEO's drop mic situation, and you know that it's going to be awful for the stock. You can trade. You can short it. Spread betting is traded through leverage, whereas in traditional trading, the trader has to pay the total amount for the shares up front. And for more details about the tax side of things, also, I want to show you a very handy place to go to, which you can find on the IG.com page. So this is a very handy site, ways to trade. If you go down, it also explains to you quite simply the benefits of spread betting and also traditional, how it differs from traditional share dealing. So that is a quick synopsis of the differences between the two. Anything to add, Rich?
No, I think the idea of being able to gain exposure and express your idea on stocks going down as well as up, or doing potential protecting yourself against a long-standing position like we just went through. The ability to buy downside protection, the ability to go short things, that's a real advantage.
Right, next question.
How does trading futures compare to trading stocks and ETFs?
Right, this is a really good question. Futures contracts, I tend to use them when it comes to commodities. But you can lock in the current price of a commodity or stock and also define the current fixed cost of the underlying asset and its expiry date. Now, what's interesting about this is it gives you the ability the futures are leverage, right? So like what Rich was saying earlier, it gives you the ability to make quick decisions, come in and out. And it gives you the ability to hedge as well. Leverage, for those of you that are new to this term, just means that traders don't have to invest the full 100% of the underlying asset's value of their own money to enter the trade. So traditional stock trading, well, we've already explained that, right? You buy and sell shares in public companies called stocks. But ETFs, exchange traded funds, the biggest difference between ETFs and stocks is that the stock represents owning parts of a company, whereas an exchange traded fund is a collection of investable assets. Some people like ETFs because it gives you a broader spectrum, like if you bought like a renewable energy ETF, and it gives you a wider, some people call it diversification, if you like it. Skeptics, see Rich grinning there, say that it goes against traditional real belt and braces stock picking.
Oh, the old-fashioned crew, right?
Yeah.
I mean, that's the welcome to the 21st century. So the way I like to think about it is that a single stock is like going into a restaurant, which we are doing later today, aren't we, Ange?
We are. Very excited.
Going into a restaurant and having an a la carte menu and only being able to choose one main course, right? That is a big risk. If I haven't been to the restaurant before, I don't know how it tastes. I don't know if this is their strongest dish, and I might not be able even to read it if it's in French. But consequently, buying an ETF, which has a large diversification, is like going for tapas. And instead of one main dish, 6 small tapas dishes cost the same amount, but I know that I've got a chance of a lot less risk.
But also using the restaurant explanation, it depends on which side you sit on. So those restaurateurs, Michelin star, would say, the problem with going for a buffet or tapas is you might get a range of meh dishes. Just giving you both sides of the story, trader friends, because there are always both sides. It takes two to tango. And so, they would say that actually it's far better to know what you want, know your dish inside out, and get that one really great dish. Or if you're spread betting and you can go short, know which one is that dish like you have to absolutely avoid, right? So there are two sides of the story. One is, yes, it can give you diversification, but also those who are fans of stock picking would say go down the individual stock picking route.
That's it. If you were really strong conviction on Tesco, you don't want to buy a European and UK supermarkets ETF, you want to buy Tesco. If you're a fan of that club card, if you think you get your deliveries on time, then that's the time to go for your a la carte, isn't it?
Yeah, Monkey Man also joining in here saying he thinks, or she thinks, man, M-A-N-N, being absolutely, on the offensive. I think ETFs in a recession can be high risk. So.
Yes, especially, and just to develop that idea as well. So exchange traded products is the basket of everything, right? So they all come under exchange traded products. That's right. In which you get ETFs, you get ETCs. So if you want to buy something like a Wisdom Tree gold or Wisdom Tree copper ETCs, that's exchange traded commodities. And then you start to get into the funky stuff like leverage ETPs, and that's exchange traded products. And those are the ones that if you have a really strong conviction on the likes of Nvidia or Tesla, then you can start to look at the leverage ETPs. But those are definitely only for sophisticated investors. So take a look at something like Investopedia to get more information on those.
And those that like ETFs, you can trade it like a stock, right? So and we offer a huge range of ETFs on the IG platform as well.
See if I can find the ones, for example. So that's a great example of ETFs, right? That is by sector, the way that you can get that tapas, like I say, right? That's all the material. So all the US mining stocks will be in this one. So instead of just buying Freeport McMoran, I'll buy the materials. Instead of just buying Bank of America, I'll buy the financials XLF. So these are really popular in the US and in Europe. We can have the European versions as well. And the European versions are great because then you can see how each sector is doing on the day. Look at that. The big losers of the day, you can see are the autos down 1.3, basic resources down 1.2, and UK and European retail there getting helped by Tesco, just above Unch on the day.
We also offer Wisdom Tree, like Rich mentioned earlier, and also Crane Shares, for example, on the IG platform, if that's your thing. But that is a quick summary of the differences. So I hope that was helpful.
I think it was.
And now let's get to the break, and we'll see you shortly.
Rise and shine with IG's new morning show, Trade Live with IG, covering all our UK product offerings, including our OTC and exciting new US listed products. Trading Day live with IG.
CFD trading is the buying and selling of CFDs, or contracts for difference. As a derivative product, CFDs enable you to trade shares, indices, forex, commodities and more, without ever needing to own the underlying asset. When you trade CFDs, you trade the difference in the price of an asset from the point at which the contract is opened to when it's closed. As you don't own the underlying asset, you can trade markets that are falling as well as those that are rising. So, how exactly do you trade CFDs? Each contract has a buy and a sell price. Sell prices are slightly lower than the current market price, and buy prices are slightly higher. The difference between the two is referred to as the spread. If you think the market will rise, you would buy. This is called going long. If you think the market will fall, you would sell, known as going short. The more the market moves in the direction you predict, the larger your profits. If it moves in the opposite direction, the greater your loss. CFDs are traded on leverage, which means that you only need a small deposit, known as a margin, to gain full market exposure. So, if you wanted to open a position equivalent to 500 Apple shares, you might only need to put up 20% of the cost. Your profit or loss is calculated based on the full value of the trade, however, which could mean magnified gains, but also magnified losses. So, when trading CFDs, you should always keep an eye on the potential downside. Take care to manage your risk with stops and limits. Visit IG Academy to learn more.
Hi, I'm Sean Mearson, Senior Market Analyst at IG, and join us for our new show, Charting Essentials. That's every fortnight on IG.com, our trading platform, as well as YouTube. And that's a show where we look at everything technical analysis, hoping to help you upskill, whether you're starting out or just looking to level up. We got you covered. In each episode, we'll break down complex concepts into easy to understand lessons, provide practical tips to help you sharpen your chart reading abilities, explore powerful technical indicators and their real-world applications, as well as guide you through hands-on examples to reinforce your learning. So come, let's work on our skills. Let's get better at this. Let's accelerate that trading journey, learn to have confidence to trade, and make informed trading decisions.
Welcome to IG's Charting the Markets, your gateway to expert technical analysis and market forecasts. Our video series breaks down the complex world of technical analysis into three key asset classes: indices, forex, and commodities. Watch as IG's expert analysts dissect charts, spot trends, and provide actionable insights. Whether you're tracking global indices, navigating currency pairs, or exploring commodity markets, we've got you covered. Sharpen your technical analysis skills and make informed decisions. Join us for charting the markets every week in IG's trading platform and on IG.com, where data meets clarity. Start watching now and stay ahead of the curve.
Fundamental analysis is a method of evaluating assets to assess what their prices should be. It's based on the principle that every asset has a real fair value, which may be very different to its current price. It assumes that markets will naturally correct to reflect these fair values over time. The aim is to discover assets that are currently underpriced or overpriced, then place trades to profit from the expected correction if it materializes. Now, unlike a technical analysis that focuses on price charts, a detailed fundamental analysis would look at everything that could drive future price movements. The technique is most commonly used to scrutinize the price of shares, where annual reports, industry trends, and a company's management team may form part of an overall assessment. However, fundamental analysis can be used to review the price of an asset. A commodity like oil, for example, could be evaluated on the basis of economic data, regulation, brand recognition, geopolitical factors, and technical specification, among other factors. But while fundamental analysis is often said to be more comprehensive than technical analysis, it may not give you the full picture. For one thing, it's generally only useful for identifying long-term trends, whereas a technical analysis can help find short-term opportunities. For this reason, it's often a good idea to combine elements of both types to get the most accurate view of a market's direction. To learn more about fundamental analysis, join IG Academy today. It's completely free and gives you access to dozens of trading topics.
Welcome back. We are live. This is the Tom Takeover.
The Tom Takeover, everybody.
You've had your go. As a quick recap, over the last few segments we've been on together, you've forced me to drink large amounts of hot coffee. You have obscured my face behind a polystyrene box.
That was an improvement, some said on the comments.
Okay,
not me.
Yeah. You have put me through a live maths test, which didn't go very well.
But still, Frank's was the worst. Frank's grilling you on kurtosis.
Yes, but I'm not expected to know that, whereas I am expected to know my 2 and 3 times table.
Did your wife mention that when you got home?
It was like, I sat back at my desk and it was immediate. She was like, what's 38 divided by 2?
Tremendous. Right, so now is your opportunity to get me back. Pete Ward's tried it. He came in with the fists up.
Yeah, well, we'll see how we
Failed.
go. We'll see how we go. So, quick recap of what we've covered so far. You taught me about earnings per share.
Correct.
As a way of comparing companies' profitability. Mm-hmm. You taught me about PE ratio, right? As a way of kind of understanding, is a stock undervalued or overvalued, right?
Nice. Yeah.
We looked at
you did learn. I wasn't sure. I'm quite impressed.
Just regurgitating. And we also talked about forward PE ratio, right?
Yes.
So using a company's expected earnings in order to look forward and see what their forward PE ratio is. So where we left off last time, we were talking about Marks & Spencer's, and we agreed that the Marks & Spencer's forward PE ratio, as of right now, is 14.
Yes.
Okay?
Beautiful.
That's where it is right now.
Yep.
We're going to test you a little bit today, because you've been given all that.
On Marks & Spencer's clothing, or we're
I'm
moving
the
on?
On Marks & Spencer's. Oh,
I did, yeah, represented good. Not sponsored segment, by the way. It should be, but it's not.
But it will be.
Yep.
So Marks & Spencer's forward PE ratio is 14.
It's 14, correct.
At the moment. Okay.
At £3.80.
We're going to take you through a few other stocks from different industries and different countries, okay? And you're going to play a game of
cross-country.
Cross-country, of course, of higher or lower.
Bruce's Price is Right kind of thing.
Exactly like that, but with no prizes.
Okay, Bruce.
We'll see how you get on. I know you like a cheap prop, so we've got you 2. We've got you a red for lower, and we've got you a green for higher.
Are we going to put it the right way around?
Put it the right way up. There we go. So these are, it doesn't quite green, but there we go.
Oh, I'm looking forward to this. Right,
so I want you to let me know
Ooh, that's that's funky, isn't it? Right,
Oh,
there we
shouldn't
go.
have gone green, should I? It's the,
No, it's okay, I can
Hold up by the
keep
prop.
it. Yeah, there we go.
Okay.
Right.
Okay, so Marks and Spencer's forward P ratio was 14. I want to know for the next stock that I give you, higher or lower, and talk me through what you're thinking.
And there's no price.
There's no price.
Is there any downside?
Yeah, because when you get them all wrong, you're going to look foolish like I did with the maths test.
Excellent, right.
So, we're comparing Marks and Spencer's. So, company I've been using a lot recently because I'm trying to buy a house. It's also been in the news a lot recently because they've been subjected to bid takeovers. So, Rightmove, higher or lower than 14?
Okay, so when I was at school, secondary school, I got into trouble for not showing my working in maths, right? So I'm going to try and talk through my working here, which will probably make it a little bit more interesting. It's like Who Wants to Be a Millionaire?
Talk us through.
When they don't explain their answer. I know that the margins for Rightmove are 69%, right? Now, margins are something that goes into the consideration of PE ratio because it shows how much pricing power you've got in the sector, right? So if your costs are 20 and if your costs are 20 and the price you can charge is 100, then look at this. That's live in station. We've now got a bingo. Yeah, if your costs, like Nike, for example, right? Nike have got high margins, therefore they deserve a better PE ratio. Long story short, Rightmove's got a 69% margin. Therefore, I am going to go with Rightmove is higher than Marks and Spencer.
That is correct.
Yes.
Easy one to start. Rightmove's forward PE is 21.
21 forward PE. Okay, interesting. It shows. So the bid price was therefore about 25 times earnings that got rejected.
Okay, 1 point. It'll get harder. Next up, a staple of the British High Street. Okay, I want you to compare Rightmove at 21 to Greggs. Greggs got a forward PE of higher or lower than 21.
Oh, that's tough. Okay, the other thing that goes into PE ratio is future growth. Okay, so I would have thought that Greggs, with that introduction of that incredible sausage roll, vegan sausage roll, probably already had a lot of its bumper growth. Is it opening stores? Is Greggs only in the UK or is it abroad as well?
I can't give you additional information.
Oh, okay, viewers, on the comments section, I want to hear, are there any Greggs in other countries? If you go to a train station, if you get the Eurostar to Paris, is there a Greggs there? I don't think so. I think they've got far better taste than that, don't they? Producer Fred, do the French have better taste than the British in sausage rolls? I will go lower.
You're very lucky. It's 20. It is one lower.
Ooh.
Okay, change of tack.
Brilliant.
So we're now looking at, so Greggs' forward PE is 20, Boeing.
Very topical at the moment because there is talk of Boeing coming to market for an additional $10 billion of funding, right? So that stock has been slammed and the stock is lower. Of course, lower price relative to its earnings means that the PE ratio would have also come down, right? So the PE ratio at the moment is certainly lower than it was at the start of the year, taking the same forward earnings estimates. However, it is in America, and America traditionally trades at a higher multiple. Therefore, because the S&P is at 22, so because the America in general is at 22 times earnings, I'll say that, whoa, this is close. I'll go that it's on 22 times earnings, Boeing higher than Greggs. I can't believe I'm saying this.
You've embarrassed yourself. Boeing has a forward PE of minus 36.
Because they're taking a big loss. I would argue on an adjusted basis for earnings, that might be wrong.
I didn't ask for adjusted though, did I?
You want
You went
the
out
real.
by an incredible amount. This one should be easy for you though. So you've got minus 36 for Boeing,
Right,
reminding us that
I've got Greg's sausage roll all over my face right now.
Everyone's just witnessed how
Embarrassment.
you've got to remember that it can be negative.
That it can be, yes.
I thought you would have known that. So
Well, the next one should be easy.
the next one should be very easy actually, because the next one is Tesla.
Oh yeah. Okay. So what's Tesla's PE ratio has been as high as 150 times earnings, and people still bought it there. Why? What are you doing? So Tesla's always been the big outlier because there's always the promise of something new, robo-taxi, right? Do you remember the Simpsons episode when there was the monorail guy?
Yeah.
Monorail.
Yeah.
Monorail. Some have likened Elon Musk to the monorail guy because he's always promising things in the future. Right?
Monorail guy was a better dancer, from what I recall.
Oh yeah, that's right. Yeah, in that famous, was it the club in Berlin?
Oh, I don't know.
Or do we not speak about those places? So, right, we're definitely going that Tesla is higher than Boeing.
Correct, that was an easy one. It's 148 at the moment, it's forward.
Oh, it's
ratio.
still
very high.
On a forward PE?
On a forward PE.
Okay, please, again, in the comments, please tell me, anybody who is buying Tesla here, I think Anne's just thinking of it, why are you buying on a 148 times PE ratio? Really take that into consideration when you're looking at buying stocks. This is where it's so important right now because people have bought this all the way up from 150 earlier in the year to $260, right? And which means the PE ratio has gone up from 100 to 150. Okay.
It's a big one.
Sorry to interrupt.
No, by all means. So on the same theme, same founder, PayPal.
On a forward PE ratio, is PayPal trading at above or below 148 times earnings?
148 forward PE, yeah.
I think it's got to be lower. I think it still trades at a premium to the market. The market is 22 times earnings. FinTech, which I would argue PayPal is, should always trade at higher multiple than the S&P. Should it trade at a higher multiple than the NASDAQ? Tricky, because PayPal's just started allowing crypto on their platform. So I would guess that it trades at around between 35 and 40 multiple, but you've chosen it for a reason. You've clearly chosen it to try and be sneaky, that it's not as simple as that. I've got to go lower, but I know you're going to pull something out of the bag here.
No, it is lower. You way overthought it.
They double bluff me.
But it has a forward PE of 18 for PayPal.
Okay, only 18.
Only 18.
Wow, that is really interesting. Actually, that it trades at a discount to the S&P. That's really interesting. I'll take a look at that.
Take a look at that. And on the similar theme, tech stock, Alphabet, owner of Google, higher or lower than PayPal at 18?
Can I have the same?
You can say the same.
You tried to trick me. I think Google might be the same.
We don't have a card for that, but you can say the same.
Oh, so therefore, yeah, it must be. You were trying to trick me into saying higher. I think it's probably something like 17.9. Google, huge underperformer. Or has it rallied recently? Because I think I read this stat probably 2 weeks ago, but I haven't kept a close eye on Google, so I'm getting punished for that now. I'll go 0.1 lower than PayPal.
That is incorrect. Alphabet has a forward PE of 22.
Does it really?
It does.
Okay. No, I stand corrected and wrong on that one.
That's all right. That's
something my girlfriend's never heard me say.
That's what I was hoping for. Next up, tech stock Uber.
Yeah, Uber. I'd go strong conviction higher on that one because there's still a lot of growth there. Traditionally, Uber has been investing back into growth, investing into the line bikes, which I absolutely love, investing into various Uber Eats. So therefore, its profits are lower than they could be because it has high revenues. It then spends a lot of that on investment, so its actual earnings number is quite low. Therefore, its PE ratio would look high. Therefore, I am going higher than 22 times earnings.
Very good. It is massive at
Uber.
71.
71. And that's, if you look at the revenue, sometimes you do multiple of revenues, so a sales multiple instead of an earnings multiple, right? And if you looked at the sales multiple of Uber relative to the others, it would be a lot closer.
Okay.
But on earnings, because it's investing so much in for future growth, then that's why it looks
so high.
Looks so high.
Okay, we're running out of time. We're going to make it out of a nice even 10. After Uber, we have Uber at 71, Nvidia.
One of the most closely watched stocks in the world. I can't believe that you think you're going to trick me with Nvidia. Come on. I thought this was meant to be a challenge.
Higher or lower?
Producer Fred, can we tell him to actually make this a challenge
Stop
next
stalling.
week, please?
Higher or lower?
Absolutely, 100%. If you're going to tell me differently, you're wrong. It
is correct. It is lower at 44.
Where's my mic? Can I drop this mic?
So moving away from America.
Oh, right, okay.
For the very last couple, we're looking at the Ping An Insurance Group Company of China.
Ah, come on. What was the Nvidia 30?
44 was Nvidia.
Okay, which is wrong. It's just that the consensus earnings is too low. So that's a really interesting one as well. How are we doing on time, Producer Fred? Perfect, right. So on this one, Nvidia is really interesting because Nvidia earnings, right, some people think it's going to earn $5, some people think it's going to earn $3. So when you have such a wide discrepancy on what the earnings per share could be, then you also have this discrepancy on what PE ratios it's in, right? So some people think Nvidia is on a 44 times PE ratio. Some people think it's on a 25. So therefore, if your P ratio is between 25 and 44, that's why the stock is so volatile. Because you've got different people in the market really throwing round their weight on which one, how confident are they, how high conviction it is. Now, back to the question of relative to the insurance company in China.
Ping An Insurance Company Group of China.
Ping An. Now, China traditionally trades a much lower multiple, and that is somewhat because of confidence in potentially the government economic figures, confidence in potential, trouble in the Taiwan region. So investors had pulled out of China. If you look at something like Prudential, right? Prudential is one that you would liken to a Ping Yang. And Prudential's PE ratio has been smashed. Therefore, and knowing that Russia traded at a huge discount to everywhere else in the world at only 5 times earnings for many years, and it was a fool's valuation, then I think that any China stock will trade lower than Nvidia.
So you're going lower?
I'm going lower.
Lower than 44, that is correct. Ping An Insurance Company is at 7.
7, yeah, there you go. But you've got to be really careful because we used to buy Sberbank and the other Russian names that were on 5 times earnings because they looked so low, right? Compared with anywhere else in the world, basically, any emerging market. But of course, Russian stocks then dropped to 2 times earnings, 1 times earnings, suspended. So when you're looking look relative to their own country before you look relative to elsewhere in the world.
So in that case, relative to country, so for the last one, bear in mind...
From a PE of 7 for Ping Yang.
You've gone for 7 Ping An, so moving country to the UK, different industry to, I guess, oil and gas, BP.
Ooh, tricky one. BP trades at a discount. Oh, you've gone from Ping Yang to BP.
Ping An.
Ping An to BP. Now, BP has been hit recently, as Axel showed us on the show the other day. Real sell-off. I think it's down about £4 now, is it? This again looks like it's big value. It looks like you've got the opportunity to invest. It's on a high dividend yield. The PE ratios of all the ESG, anti-ESG, so obviously people sold because of the environmental concerns. So that made its PE ratio drop. So I would think going to be so close. For the last one,
Lower.
lower.
It's a great estimate, but it's actually wrong. It is exactly the same at 7.
I knew you tried to trick me. Why? I don't have one that is the same.
Well, it's my game. So out of 7, you scored out of 10, you scored 7, which is not bad. Unfortunately, the pass mark was 8. So you have actually failed the test, but you did pretty good.
What a failure!
And I hope that we've learned something about our different countries, different industries, and their forward PE ratios.
And I love how you've taken what we did the other day of just explaining PE ratios to you. Now you're doing quizzes on it.
It's real.
This is brilliant.
It's real.
Yeah, Marks and Spencer's. So what was the highest of everything? The highest was probably Tesla, was it?
The very highest, Tesla, 148. Lowest, Boeing, minus 36.
Minus 36. Great. Well, if you enjoyed that at home, we now are going to a viewer poll. Should Tom be invited back next week? So we're waiting. Producer Fred was a big yes. Cam was a big yes. I am unsure at this moment.
You think about it.
So let's hear your poll. Should Tom be invited? Should Tom's takeover continue for another week? Let's hear your answers. Tom, thank you very much for coming in.
You're very welcome.
And while we're back, we'll go to break.
You can find a variety of asset classes on the sidebar menu to the left of your platform. It's now time to pick an asset class. There are 4 major types. 1. Shares in individual companies listed on global stock exchanges. 2. Indices, a group of shares measuring the performance of a particular region, exchange, or sector. 3. Forex, the value of one currency compared to another, like the pound versus the dollar. 4. Commodities, like gold, oil, natural gas, or wheat. Decide which of these markets interest you and which you know the most about. It's up to you to research the market you'd like to trade. This will help inform any trading decisions you make. You need to know the risk of trading a particular market. For example, some markets react to events like economic releases. Next, look at the market's opening hours and how they'll fit into your trading plan. The deal ticket will let you know if a market is open or closed. Lastly, look at the costs and charges applicable. Once you're happy with your market choice, place a deal through the deal ticket. Options, a hugely powerful trading tool with a wide variety of uses. An option is a contract that gives you the right, but not the obligation, to trade a financial market at a set price before a set date in the future. You pay a premium for this right. Options can have daily, weekly, or monthly expiry dates. Say you think the FTSE 100 is going to rise in the next week. Instead of buying the FTSE now, you purchase an option to buy it within the next 7 days. This is known as a call option. It gives you the right to buy the index at a set price, called the strike, before the option expires. If the FTSE moves above the strike at any point within the 7 days, you can exercise your option and buy for less than the current market price. If the FTSE drops instead, you can leave your option to expire, losing only your premium. But options aren't just used to buy a market when a market goes up. Put options give you the right to sell a market at the strike instead of buying. This can make them a great tool for hedging. Say you own Apple stock and are worried it's about to fall in price. Instead of selling your stock immediately, you purchase an option to sell it with a strike that's close to the current market price. If Apple stock drops, you can exercise your option to sell, preventing losses by selling above the current level of the market. If Apple stock rises, you can keep it in your portfolio, again, only losing the premium. You can also use options to speculate on price movements without ever intending to buy or sell the underlying market. That's because an option premium will change over time, depending on how likely it is the option will become profitable. If you purchase an option with a low premium, you can sell it on if it becomes worth more as it nears expiry. With IG, you can trade an extensive range of call and put options on shares, indices, forex, and more.
Welcome back. We're here live from the IG Trade Desk, and we have no other than Ronnie Agnik. Thank you so much for joining us, Ronnie. How are you?
Thank you very much for having me. I'm doing very well. Thank you very much.
Hey, Ronnie, my son is at some point going to get sent to Copenhagen. Now, I've done a lot of Scandinavia. I know you're Swedish. I know you're not Danish. But I've never been to Denmark ever in my life. So what helpful tips would you recommend? You know, what should he do? What should he do? Where should he go? What should he pack? What should he pack?
Well, first and foremost, he definitely needs to pack his bike helmet. There's biking everywhere. That's the main form of commute. Even more than Amsterdam, I'd say.
Wow.
He should probably wear when he's walking as well, because the chance of getting hit by a bike is quite big. I almost got hit when I was there, but bike helmet, sure. Definitely some rain jacket. If you live in the UK, you're already used to that.
You do that thing like in Sweden, into Malmö, Helsingborg, and also Lund. Do they have that thing there where every bit of pastry has this green stuff in it?
Sure, but I have to admit, the Danish are better at pastries than us, so most likely they don't have it.
Didn't go to Stockholm School of Economics, did you, Ronnie? No.
It's too bad to get in there, so I had to go to Scotland.
Fantastic. Oh, I would have done a swap. Been students at the same time. I went a graduate recruitment day, Stockholm School of Economics. And they are really, that's a fantastic school. A lot of intelligent economists there.
It's the Oxford of Sweden, I'd say. It's a very good school. I had some friends who went there, much more than me, of course.
I was visiting my friends at Lund University. How does Lund University rank in Sweden?
Lund is up there for sure. It's part of the Ivy League of Sweden, if you will. Very ancient and classic university.
I know, it's a bit like a castle, a bit like Hogwarts. And I was told that a lot of Swedish CEOs come from Lund. But of course, they took me to the famous student kebab shop in front of the university. Not what I expected.
That's student tradition.
Right.
Not many kebab shops in the Stureplan, is there? That's.
No. You only have McDonald's close by there, but I should probably open one. Make a lot of money.
Right, Ronnie. What are we seeing? Has there been a real interest in? Start to the week there, and what are you seeing winners and losers on the trade desk?
Yeah, the week's been pretty hectic in terms of geopolitics. So I think the biggest losers, including myself in my demo account, is anyone long any index, any major index, especially the US tech one. It took a pretty big nosedive, recovered slightly, but still trading in the red. So the major indices are struggling quite a bit today, but the big winners are anyone who's invested in the sort of gold or oil, the commodities there. They've been proven their worth as hedges. And then VIX. VIX is a big winner this week, not only with the Middle Eastern tensions, but also it's proved its worth as a hedging tool in the US election. I don't know who's going to win, but neither does anyone else. And I think that's the rationale behind traders. So trading the VIX is a good hedging tool regardless of the outcome. So,
and that's a popular play amongst clients, is it, the VIX?
Yeah, definitely. It's something that's been picking up pace now. It's been quite slow recent months, but it's really picked up pace now, especially surrounding the U.S. election. You can see uptick when there's U.S. presidential debates. So it's proving its worth as a hedging tool, and it's definitely picking up pace now.
And I'm sure there was a pickup with Axel's trade of the week as well.
Yes, that's his trade of the week on the VIX, which you can find on the website by Googling his name and also VIX. This is really interesting because do we have any anecdotal evidence that we have more trades amongst our clients on the VIX as we approach the US elections?
I'm not sure about IG's clients per se, but overall in the trading markets, the VIX is always something that picks up pace around an election, and volatility always increases just before the election and just after, when you have that sort of tension and unwariness of what's actually going to happen. It always slows down a bit afterwards, but if you look at the sort of VIX graph zoomed out, you can see that around the elections it always picks up, and I'm guessing. So we'll have the US election in November, early November, and then we also have the UK budget at the end of October. So that's going to be a very hectic week for the VIX, I think. So I'm probably going to take a long position in my demo account, but with my luck, it'd probably go just the other way.
Oh, never. Come on, the luck of the Swedish.
Yeah, the luck of the Swedish. Also looking at the volatility index on a monthly view here, and also on the daily view. I was writing. Did you see me writing on my little notepad as Ronnie was talking? To try and place a trade on the VIX as we get closer to the election. But yeah, there are some interesting signals there. How about gold, and which is very well traded on the IG platform? And of course, the dollar and cable. Are those also ones that are most traded as we're now in the countdown to the US elections?
Yeah, gold is absolutely rallying. Goldman Sachs even adjusted its price level from 2,700 to 2,900.
Ooh, hadn't seen that.
So it's absolutely rallying.
Oh, 2,800.
Yeah, so it's definitely picking up pace, and I don't see it stopping anytime soon with everything going on in the world. And also, it's proven itself as a hedge not only to the geopolitical tensions, but also with the port strike going on in the US. Over 36 ports are going on strike, so there's a lot of sort of regular retailers and such that are taking a hit, and the US economy is predicted to lose $4.5 billion a day, according to JP Morgan, as long as the strike is going on. So we have the port strikes, we have the automobile strikes, Boeing is striking as well. So the sort of labor market is really in deep trouble. So I think we're going to see a further rate cut, and then we're also going to see further long position exposure in gold as a hedge.
And it's all a play until Friday 1:30 as well, isn't it? Friday 1:30, non-farm numbers that Ronnie mentioned. How is the labour market going to look?
Yeah, interesting. And also those Middle East tensions. What sort of market action have you seen since tensions escalated over there?
Yeah, so like I said, gold's been rallying, as it's always a safe haven. As soon as there's worry in the world, gold's rallying. But we also see a major pickup in sort of the defense sector. So we see Lockheed Martin, the classic sort of American weapons company, they rallied to an all-time high on October 1st. Bay systems in the UK rallied as well October 1st, and so did the FTSE 350 defense. And if you look at the sort of the sentiment, it's very long there, and especially not only amongst the US defense and UK defense, but also oil. Oil's rallying, it reached 75. It sort of broke that resistance level. It's back down below that now, but it's definitely something that's been looked at as a hedge. And then we also have sort of the oil companies, Chevron, Exxon, BP, Shell, Total Energies, they're all rallying. And if you look at client sentiment on these, they're almost 99-100%. So as a sort of hedge towards the Middle Eastern tensions and as the risk of a full-out Middle Eastern war is getting closer, it feels like every day we're the closest we've ever been. So the sort of positioning themselves in long positions in oil and oil companies, energy companies, is definitely something people are taking action towards.
And that's a good plug there, Ronnie, for on the app. So everybody, on their phone, if you look at the app and then you've got the Explore button at the bottom, you can find out what the top 100 traders of IG, as Pete said, that doesn't include myself, don't make it into that top 100, and certainly does. We've got the most popular positions right now: long crude, as you said, long BP, and then other ones out of interest: long Vodafone, which is one that I am absolutely guilty of myself. Long Russell 2000. That's a new one on the list.
Well, that's the whole play that we're talking with Frank about. That sort of conversion or coming out of the big indices into the smaller cap. Remember we talked about that about 4 weeks ago or 3 weeks ago? It seems like
and there's different ways to play that. I don't know. Ronnie, do you see anybody trade the S&P 500 equal weight? Because I think it's only an ETF.
We don't see very much action in that. I think it's a bit under the radar, so it's good that you brought it up. But I think the US 500, the S&P 500 equal weight is a great tech hedge, because now with the Magnificent Seven, it's very overweight in those sectors, especially Nvidia, Alphabet. So I think a good hedge, you still want the exposure, but you don't want as much tech-heavy exposure. The equal weight is a great option.
Yeah, it is. It's nice, and it'll be really interesting to see the performance of S&P 500, S&P equal weight, which, just for anybody at home, remember that over 30% of the S&P 500 is in the top 7 names, right? So you've got the Mag 7 and then you've got the S&P 493, right? If you want more exposure to this 493, which is trading around 18 times earnings, as opposed to the 22 times earnings of the S&P 500, if you want more exposure to the 493, you can look at the S&P 500 equal weight, which is available on the platform. Just search that in the toolbar. Actually, I'll have a go at that for you. And
Ronnie, whilst Richard's searching, I really like the fact that Rich pointed out the mobile app, that on our desktop app as well, desktop IG.com platform, you've got tip ranks, you've got fundamentals, you've got client sentiment and signals. Which ones do our clients like best? I met a few of them last week, and a lot of them seem to like tip ranks, but is there one that your clients favor more over others?
I think tip ranks is the one that gives the biggest sort of overview and a more holistic approach to it. So we can always look at client sentiment, of course, but that simply shows what other clients are trading. But the tip rank shows.
Should we just show our viewers where tip ranks is? It's right at the top of the IG platform, where you see the chart. Like I'm looking at Shell right now, but you just scoot over to the right-hand side and click on tip ranks.
Exactly, and it gives you a complete overview and perspective, and you can, if you press view more, you'll see what analysts are thinking as well, the professional analysts, and you can also see the rating of the analyst, how much of their pickings they get right and how many of them they get wrong. So it's a great way to get a holistic opinion and overview of what the markets are thinking, and the professionals as well.
It's a really useful, and that's one that I didn't know was there before I came and joined you in the studio here, Ange. So that's one I'd certainly be used. You know, an example is Jeffrey's absolutely nailed BMW, right? They had it as underweight all the way down, and then they've upgraded to neutral today. So you know, some analysts in some stocks in some sectors can very much be worth watching.
Exactly. You learn to pick up the ones that you actually enjoy and the ones that will get the things right. And you look at people, for example, you know, in China shares, everyone was underweight in that, and then the sort of bazooka came from the Chinese government, and now everyone's longing it. It's just going through the moon. So anyone who took a short position in that was in some trouble. But we'll see how long the effects are lasting. You know, macroeconomic and sort of political or economic doping from the government doesn't often last very long. So we'll see how long that sort of bazooka rally can continue in China.
I like it, economic doping.
Yeah, I love it. Ronnie, do you also have your bobs? Because you know, with the analysts, I also like contrarian indicators. I call them, you know, bobs. When you find one that's wrong so consistently that, you know, you look for this particular analyst so that you make the opposite of their recommendation.
Yeah, that's my demo account. So whatever I do in my demo account, I do the opposite in the real one.
Brilliant, genius. Right, Ronnie, just before we leave you, and we are sad to leave you, just that iShares S&P 500 equal weight that I mentioned. So there it is. That's how you find it on the app, people. That's how you find it on the platform. The iShares S&P 500 equal weight ETF. That is when you're worried about the Mag 7. That's when you're worried about tech, and you want to rather invest in the 493 other stocks. The tech names are still there, they're still in the basket, but they are, as the name suggests, of equal weight. They're not 8% Apple, 7% Nvidia, 4% Tesla, 4% Amazon, 4% Alphabet. You know, they are, well, it will be, I think, 0.2%, ranging down to 0.05%.
Ronnie, thank you very much. In Swedish, I believe it's tack tack. Is that right? See
Close
you later. Hey, and tack tack, is that thank you?
Tax, thank you.
Yeah,
very
tack,
much.
thank you. And hey for goodbye, right?
Great.
For goodbye.
Hey, hello.
Excellent. Let's go on to market measures.
Hey, welcome back, trader friends, and we are on market measures, one of our favorite segments on this show. What we got, Rich?
So Sahil today giving us a look at stock splits, right? Are stock splits ever useful for investors to find some maybe hidden value, or is the investment useful from when the stock split's announced until certain number of months after? That's what we're going to look at. And we're also going to talk about pizza at the same time.
Pizza, I love pizza. Although the Chinese hate pizza in general. I'm going to get a lot of because they think it's just eating expensive bread. I've been told by my mum, you're not going there, you're just paying for expensive bread.
Right, let's jump straight into it then. So SMCI, which is super micro. Now, I sometimes get mixed up with Sun Micro. So if I mention Sun Micro by mistake, that is, of course, a company that was taken over a long time ago. Super Micro completed a 10-for-1 stock split, meaning that the number of SMCI shares increased tenfold, right? While the value of each share is reduced to 1/10 of its pre-split value. So as the name suggests, you're getting 10 shares for every one that you had before, but the value of the share is reduced by 90% and you've only got 1/10. So the day before, SMCI stock price was trading near $416. After the split, the new stock price goes straight down to $41.60, right? So you can see what happens. If an investor had one share of FMCI before the split, their position would convert to 10 shares of FMCI, each worth $41.60. Okay? Mm-hmm. So if it, running with that, if it was a 2-for-1, the stock price would go from 416 to 208. right? So whether they're not always 10 for ones, they can be 2 for ones, 3 for ones, 5 for ones, whatever it is, it's simply the price divided by the number of new shares. Now, why do companies split their stock, and how does that impact investors? Well, the reason they split their stocks for several different reasons, including making the stock more affordable. Of course, so if you had previously to buy one share in the company was going to cost you $416, it makes it much more affordable for people that only want to buy, invest for $40, $80, $120. A lower share price can make the stock more accessible to smaller investors who were not able to buy it before. It improves liquidity, right? Of course, you've got 10 times as many shares. So therefore, 10 times as many shares are being traded, everything else being equal. The increased number of shares can make it easier for investors to trade. And also signaling management's confidence. Right? A stock split can signal management's confidence in the company's current and future performance. Nvidia was trading at $1,200 and they did a 10 for 1 to bring it down to $120. Jensen wouldn't have done that if he thought the stock had a chance of dropping by 70% in the future, because of course a stock trading at $20 or $30 might not be something that he would want compared with $120 that the split came to. But outside those reasons, should it actually affect the stock price? So there we go. There was a huge bump in the super micro systems price, reaching 1,200 at one point, almost 6 times higher than the average price the year before. This could have been one motivation for the company to split, but as you see, it dropped all the way back from 1,200 to 416. Now, here are the top 5 most anticipated stock splits this year, right? What really got people excited? So the top 5 stock splits of the year that we've seen, the most common stock split ratio is between 2 to 1 and 5 to 1, right? Or 2 shares for every 1 share you held before, or 5 shares for every share you held before. But this is because these stocks prices were so high, right? The ratio has been adjusted to 10 to 1 or higher. And there you see it in the stock. Did you hold any of these over the splits, Ange?
Nvidia, but because I've got a very long Nvidia holding. But I'm just interested to see that Walmart, 54%.
Yeah, Walmart, incredible performer on the year.
Yeah.
Really, really has been impressive. So yeah, so the stocks we've had are Nvidia, CMG, Avgo. Avgo is of course Broadcom. I actually don't know why is it ticker is Avgo? I don't know.
I don't know why it's Avgo either. It's not very memorable, is it? It's not like so my favorite ticker, Avgo. My favorite ticker of all time is mRNA.
Right.
Because it really simply stands for what the company does.
Yeah, that's true. Yeah.
And it's easy to remember.
Actually, isn't it?
Yeah, but I don't know why it's Avgo. We need to find out.
Yeah, in the comments, please. Why is Avgo? I assume Broadcom changed their name from something else beforehand. But
producer Fred says it used to be called Avago Technology.
There we go.
Right,
okay,
Fred?
so
Avago.
Avgo. Avago Technologies. Right. So they did a 10 for 1. Walmart did a 3 for 1. And on the right-hand side there, you see post-split performance. Right. So post-split performance. So let's take a closer look at that. Since the beginning of this year, the S&P has surged 20%, outperforming most of the stock splits. For instance, Nvidia's stock price increased by 240% in 2023, but only marginally moved since the stock split. This raises the question, does a stock split really boost the price upwards? And this is where I want to bring pizza into it, right? Now, if you have a full pizza, and we can go back to vision here. So if you have a full pizza and that pizza cost £10, right? So one of the real Waitrose premium kind of ones.
It's really
the value of that
taste in
pizza.
You have
Oh,
very
that's-
expensive taste in pizza. I mean, like,
you got
I'm
to.
more like a 3 for, 12.
The Tesco delivery ones.
Yeah.
If we have a full pizza and it costs £10, then the price of that, the value of that pizza is £10. If we cut it in half, right, and we charge £5 for each pizza slice, each half, then the value of the whole pizza is still
10.
If
Am
we
I going
then
to be
cut
rich
it,
again? Am I going to be rich again?
if we then cut it into quarters and we try to charge £3 per slice, right, as some pizza places would do, then the value is £12. So then we have created an increase in value,
Yes.
right? We then cut it into eighths, and for eighths we try and charge £2 a slice. Then the value goes up to 16. But does that happen with shares? No, it isn't. You're not creating any value just by cutting the same company into more slices, right? You're not slices, right? You're not. There's the three reasons that we touched on earlier. That's fine. But in these current days, I just do not see. When you can go onto Robinhood and you can buy 0.2% of a Boeing share, small investor type, or 0.1% on something like Trading 212, right? You can already buy decimals of shares. Therefore, it doesn't matter if you make the share. And big institutions aren't worried. Investors, they are the big institutions, and big are not the. I like to think of $20. So because does it affect the EPS? I like to think of affect the EPS, earnings per share. And when it comes to yes, well, it does. You're dividing earnings per share as each pizza slice. And that's the way to remember it. So, looking at 10 for 1, the data shows a split doesn't necessarily guarantee better returns. Stock split doesn't necessarily.
Time frame matter. What process for Sahil Baby Shark is good because
simply holding the S&P with.
Does it matter?
Well, in the stocks that have split.
Matter?
Well, that's perfect. That's exact. After 1 month, in the stocks that have split was 0.7.
Does the time frame matter? Does it matter?
Well, that's perfect. That's exactly what he's looked at here. Volatility, right? Remember, volatility. So next, let's take a look at 3 splits since 2000. February of 2004.
You almost cannot a staple. Every fund manager a staple.
Yeah.
It's really hard to even avoid it if you wanted to diversify.
Yeah, you cannot diversify away from Apple, can you? It's very, very tricky. So we recorded its performance for 12 months directly after each stock split, compared it to the average performance of a randomly selected 12-month period. I do want to hear from Sahil how he randomly selected the other stocks.
Have you not seen his monkey with the wheel?
Oh, really? Okay, like some other stocks, Apple yielded a positive return, averaging 10% in the 12 months following the stock split. However, it had an even better performance during randomly selected trading periods of the same length. Now look at this. Do you want to take us through that table there, Ange?
So Apple, 12 months following split, so the return was plus 9.6%. And randomly selected months, this is Sahil's randomly selected 12 months with the monkey in the wheel, plus 38.4%.
Right, so significant outperformance of the randomly selected.
Yes, volatility plus or minus 56.8%.
So these observations tell us that while the initial signalling of a stock split is generally positive, when it's announced, retail investors especially seem to love these things, right? I remember shouting at my television when Tesla was up 8% just because it had announced the stock split. What are you doing? It does not guarantee a better performance, right? Stock splits do not guarantee a better performance. Even if the returns in the following months are positive, they should be compared to the stock's long-term average performance. Would it have continued to perform the same way even if they hadn't split the stock? So the big takeaways today: stock splits provide various benefits to retail traders, including a more affordable price and better liquidity. They often send positive signals to the market, and that's undeniable, right? There is the confidence factor. However, the action of stock splits does not necessarily indicate future performance. Thank you, Sahil, for that one. A great section on stock splits.
There you go. There's Sahil's salad dressing. The stock splits do not necessarily equate to better stock performance. And I like that pizza EPS thing. I'll never look at it the same way again.
Salad dressing
ESP.
and pizza. Are we hungry?
Salad dressing, pizza. We are very hungry. Right, we're going to go have a short break and we'll be back with what's next.
Hi, I'm Sean Murison, Senior Market Analyst at IG, and join us for our new show, Charting Essentials. That's every fortnight on IG.com, our trading platform, as well as YouTube. And that's a show where we look at everything technical analysis, hoping to help you upskill. Whether you're starting out or just looking to level up, we got you covered. In each episode, we'll break down complex concepts into easy to understand lessons, provide practical tips to help you sharpen your chart reading abilities, explore powerful technical indicators and their real-world applications, as well as guide you through hands-on examples to reinforce your learning. So come, let's work on our skills. Let's get better at this, accelerate that trading journey, learn to and make informed trading decisions.
Welcome to IG's Charting the Markets, your gateway to expert technical analysis and market forecasts. Our video series breaks down the complex world of technical analysis into three key asset classes: indices, forex, and commodities. Watch as IG's expert analysts dissect charts, spot trends, and provide actionable insights. Whether you're tracking global indices, navigating currency pairs, or exploring commodities, we've got you covered. Sharpen your technical skills and make informed decisions. Join us for Charting the Markets trading platform and on IG.com. Needs clarity. Start watching.
Fundamental analysis is a method of evaluating assets to assess what the principle that every asset has a real fair value, which may be very different to its current price. It assumes that markets will naturally correct to reflect these fair values over time. The aim is to discover assets that are currently underpriced or overpriced. then place trades to profit from the expected correction if it materializes. Now, unlike a technical analysis that focuses on price charts, a detailed fundamental analysis would look at everything that could drive future price movements. The technique is most commonly used to scrutinize the price of shares, where annual reports, industry trends, and a company's management team may form part of an overall assessment. However, fundamental analysis can be used to review the price of an asset. A commodity like oil, for example, could be evaluated on the basis of economic data, regulation, brand recognition, geopolitical factors, and technical specification, among other factors. But while fundamental analysis is often said to be more comprehensive than technical analysis, it may not give you the full picture. For one thing, it's generally only useful for identifying long-term trends, whereas a technical analysis can help find short-term opportunities. For this reason, it's often a good idea to combine elements of both types to get the most accurate view of a market's direction. To learn more about fundamental analysis, join IG Academy today. It's completely free and gives you access to dozens of trading topics.
Welcome back to What's Next.
Welcome back indeed. So the advert just before the break there. That's a brand new one. First time I've seen it, and a brand new one. First time I've seen it, and that's advertising Tom Sosnoff, coming to the UK to trade live in front of your eyes. The tickets are free. Sign up now. So you can go to 20 years on the Chicago Board of Options, and then of course built Tasty for $1 billion. If you want to know about somebody, trade them live in front of Chicago Board of Options. Tasty trade to be worth over $1 billion. If you want to know about options and you want to see somebody trade them live in front of your eyes, then get down to one of those locations. Edinburgh, Monday the 11th. Birmingham, the 12th of November. Manchester.
Letting you know, that's been tried before. Right. Right. Let's hide before. Right. That's been tried before. Just letting you know, that's
getting that goes against the grain because we're interesting. Nvidia,
and it's because of this open AI story.
Getting
$1 billion with
else.
Yeah, and it's because of this off and Nvidia amongst, and it's because of this open AI store. Nvidia amongst at 100 and amongst investors at 150. Nvidia amongst in ChatGPT at was, and pretty much companies in the world. 150 bolster its position as one of the most valuable is higher because world. So that companies in the world, other investors, Japan's investment bank giant is higher because Nvidia. What's interesting though, Rich?
Did they not get involved? That's really interesting, considering their now reliance on AI for their AI feature on their smartphones.
Yeah, but fundraising round may have also included steps to protect OpenAI's advantage over competitors. Of course, you know, those surprise, no prizes for guessing. Those on the ban list from, you know, this investment round, Amazon-backed Anthropic.
Other all sessions movers, we've got Apple down 40 basis points, Amazon down 60 basis points, much in line with the futures. Oh dear, there.
NIO also all session stock, and we're seeing the China effect starting to recede, especially with the focus now on the tensions in the Middle East. But NIO, which had quite a few stellar sessions, are down 4.1% or 4.2% now. JD.com also down 3.6%. Baidu down 3.5%. So all those that gained in the last few sessions are now lower. Whilst Rich is taking you through the rest, I'm going to actually make a gold trade here whilst I see the charts. So gold.
I'll take a look at Tesla. So Tesla down another 2% after yesterday's move on those weak monthly sales. Tesla is down 2% this morning. They must have heard Tom talk about its high PE ratio. So it has traded, it dipped down to around the 240 level and has subsequently bounced back. So 244 Tesla down between 1.5% and 2% pre-market there in the all sessions.
So just taking a nibble at gold, this is a long now because I just want to make sure that, you know, given all that's happening, you know, the strikes, the tensions, the Middle East, you know, uncertainty, just want to, this is like sort of a 2-day trade, shall we call it, just seeing whether I can try and position it so that I've got the ability to perhaps just come away with a bit of a nibble there, because I think there is something to be had there. We'll see.
Just run us through so the stop. So
I'm putting my limit at around there, and my stop is going to be quite tight over. Right.
So that's about 2,648 limits that. Take profit, and then so $3 lower. $2 lower for the stop and $3 higher for the take profit.
Yeah.
Got it there. Okay. So a little bit of scalping on gold.
Bit of scalping, yeah. Something that I might take off after our lunch today.
That's right. Yeah. Ange and I are off to lunch into Soho.
Yes, and we are going to try a new place called Singapula.
Singapula. That's right. But I do now. So. From Monday, we're going to have a new segment called Teaching Pega to Trade.
Hey!
Which I'm very excited about. And this is going to take you through from, if you've never traded before, how do you first start making those steps? And we're going to run this over 6 to 8 weeks, right, depending on how much Pega enjoys it.
She's great fun.
And we're going to take you from zero to hero.
Hey!
Right? But Pega is the head of HR.
So don't do a rich on her, okay? Don't do it.
Not sure what you're referring to. You are trying to get me into trouble.
Do not do a rich on her, because Tom's been rich, I've been rich. You know, so some other viewers have said, yeah, we notice he likes a lot of mental maths early in the morning.
Mental maths early in the morning. But I am worried that you're trying to do a kier on me.
What's a kier?
Because Ange has organised for us to go to lunch today, and she's also organised for us to go to Shakespeare's Theatre with Teach First, the wonderful charity that IG supports. But are we getting free tickets? That's the question, because Keir Starmer set to repay £6,000 of gifts, including Taylor Swift tickets.
He got Swiftie tickets given to him?
Given to him.
No.
How many people across the country would have done anything to get into Taylor Swift? Keir Starmer got them for free.
Do you know, I know more adults than children who went to the Swiftie concert. I'm a big Tay-Tay fan. There you go, full disclosure.
A Swiftie?
a Swiftie, and you know, really like amazing. If we could get the Swiftie, or otherwise known as the Church of Taylor Swift. Have you heard of this?
Is that right now?
She brings in more money than the Pope. But the number of adults that I knew that went for this, it was incredible, and more adults than children, might I add, because the tickets, A, were so expensive, and B, you could not get them for love nor money unless you decided to buy them off someone else. Unbelievable, unbelievable.
But so I'm seeing a conspiracy going on here. So we're getting the head of HR in with me next week, and then Ange's setting up free trip to Shakespeare Theatre. I'm going to have to be careful of you on.
The one that I heard about Keir, it was the apartment, or the empty apartment that Keir's child was able to go and study, like free of charge, and just get away from the noise.
Yeah, there's certainly been quite a few stories. Now, in the comments section that we are very happy to have on YouTube, you know, feel free to drop us a comment. Am I going the right way this time, producer Fred? Comment section. We are so KBL1 has just placed their first ever covered call. Right, so we went over covered calls in the FTSE description in Confirm and Send. If you missed that section today, definitely go back, because we explained how to hedge your long-term FTSE long position with a potential covered call, financing, downside protection. So that was a really good one today. And we've had KBL1 just placing the first ever covered call. Neil. There we go. Higher up, we saw that Neil disclosed his name, and thank you very much for the comments there. So, yeah, remember, we are just here for education and entertainment. Am I education and you're entertainment, or is it the other way around?
I think it's a bit of both, isn't it?
It is, yeah. Well, you're far more entertaining than my dull tones giving you the market measures every day. Shall we take a look on the...
Just taking a look at commodities, because oil is obviously an interesting space, and just looking at my workspace here, because I did have, I'm still waiting, and this is based on a technical signal. I did have initially a short on oil, but I might have to take that off and decide on a new position because of what's happening at the moment in the Middle East. And also, what's key is to, I mean, oil's an interesting one, right? We've got also the dynamic of this now this recession risk that's been talked about, but you know, at the same time, we've got some escalating hostilities in the Middle East, and no one really knows where that's headed just yet. Are you also looking at some of the trades this morning? I'm looking at the VIX as well after that chat with Ronnie.
Yeah, absolutely.
So, yeah, maybe a long on that, actually.
A reminder, this was Axel's trade of the week to be long VIX.
Yeah.
And that even before things escalated. So, you know, he's very much looking at the non-farm number on Friday. He's looking at the port strike. So there's numerous things going on which could see upside in the VIX. Then switching to FTSE, one story we didn't cover this morning was, of course, the home builders. We mentioned Andrew Bailey's comments around seize the opportunity for more rate cuts in the UK than currently expected. And how are the home builders reacting to this? Well, Persimmon is now one of the top performers on the day. So Persimmon up 3.2%. You can see this is the where it opened. So it opened around the 1654 level, now trading up as high as 1677. So Barratt Developments also chasing higher there as well, up 2.3%, with Tesco, after stellar results, raising guidance, up 2.8% on the day.
Do you feel like, you know, with the Bank of England now hinting potentially at more cuts, that the UK house builders, which were beaten down, right, they were absolutely hammered earlier this year, do you think they've now turned a corner? Because, you know, now we're seeing Barratt up, Taylor's also up, Taylor Wimpey, Bellware also up 2%, Crest Nicholson up 2% as well, and, you know, it's now sort of like that pivot point for UK house builders.
And I wonder how much comes into the budget as well. You know, I wonder if we'll hear more about the Labour Party's plan to build these. Was it 2 million additional homes across the country? Not sure about that number, but the big promise that there will be more homes built.
And certainly Keir, speaking of the Keir effect, he did promise before the elections that there would be a reclassification of brown land, right? And so the release of these areas, which potentially are land that is considered green or brown, but then actually they can be released because it used to be where a petrol station was, for example, or disused car park, places that can be renamed so that it can be released to create housing stock.
Which is a big thing. A little bit of a question of does extra supply affect prices? So any first-time buyer, that helps. But if you're an existing property owner, do you want this huge supply to come on? That would be.
Do you want to hear the Ong view?
Yes.
I think we have so much demand that actually, unless it's a huge tranche, but the UK, if I might say so myself, is a wonderful place to live, and it's very green. You're never in danger of some sort of animal eating you as you're walking in the highlands, or you might get the danger of rich, coming at you, but you don't have any. It's very benign, isn't it? It's very benign. The tropics, you leave an apple on a table, it starts moving after half an hour. But it's very benign here, and the weather is wet, but it's also not so hot that you can't live here. So we've got culture, diversity. What more could you want? That's why everyone wants to come here to work in the city as well. And so that's why I think there's always going to be demand and a lack of supply.
So very much looking forward to our lunch. And after lunch, I will be watching the PMIs coming out in the service sector. So that's the key number of the day. We've got initial jobless claims at 1:30, but subsequently at 3 p.m. watching those services PMI. How's that going to affect the employment index from the services going into non-farm tomorrow?
And all those speeches from Kashkari and Bostic as well.
I've been Rich McDonald. This has been the wonderful Angeline Ong. Have a great day.
all of that for basically an unchanged day. It is Wednesday. It's October 2nd. It's 2024. This is Overtime. I'm your host, Chris Vecchio in New York, Ilya Spivak in San Francisco, Dylan Radigan, new studio in Milan. We're here to take you through the rest of this hour as we wrap up the futures trading day. It's another day where oil prices scream to the upside, starting us moving higher. Ultimately, we see that this is a market that stabilizes over the course of the U.S. session. Stock prices here, the S&P up by 0.08%, NASDAQ up by 0.29, the Dow Jones up by 0.12, and then the Russell's off by 0.08. So not much going on there. Volumes were pretty light, 1.17 million contracts traded on ES itself. But when we look around, it's a day where those higher oil prices and day two of the port strike here on the east coast of the United States may be starting to filter through and bump up inflation expectations in the market. But we do see that bonds have a rough session. There's a mixed performance by the commodity sector, although the China trade is not dead by any stretch of the imagination. We can take a look at A-shares and FXI in a little bit. We head over to the world of FX, and despite last week's rumors that the new Japanese Prime Minister, Ishiba, would not interfere with what's happening at the Bank of Japan, he did say yesterday that the BOJ is probably done hiking rates. And the carry trade is officially back now. So let's pump those bags into the end of the year, I suppose, at least if the BOJ has their way, or at least the new Japanese Prime Minister. But guys, geopolitical risk is afoot. That is very true, at least in the short term. Israel hasn't responded. Ilya, I have no way to transition this without sounding like a total jerk. As someone who's more familiar with the holiday calendar coming up than I am, as a Gentile, how does the Rosh Hashanah Yom Kippur window ultimately impact the timing of the event risk that we have lingering around now? And I say that because it seems like there could be now a week grace period where Israel keeps this potential retaliation in the hopper, and thus the markets stay on tenterhooks.
It doesn't really seem like we have an expansion of geopolitical risk today. It seems like the dust is already settling. I mean, take a look at crude oil. It's had a wild ride today, but ultimately, what does it do after yesterday's shenanigans? CL is a goose egg. So when you look at all of this, what do you find? We get back into the highs overnight. We talked about this on the show yesterday, that Asian markets, European markets hadn't really had a crack at the news that Iran did this. What did we see overnight? Look at that long wick on the CL candle. We came right back up to the highs, tapped them again just to make sure, and then came right back down and settled, a little changed and a little lower. So it doesn't really seem like the markets are going to continue to fret very much here. Holiday calendar for those of us celebrating notwithstanding. I don't think this is anything where the markets, we're just looking at the price action here, where they're going to sit and wait and go, oh my God, they might do something in the 10 days between Rosh Hashanah and Yom Kippur. Obviously, that's an unlikely window as it is, and what Israel has shown, if anything, is a penchant to surprise. So clearly that's something that's helpful to their rebuilding of deterrence campaign, and from pagers to walkie-talkies to high-profile assassinations, everything has kind of come through a fog to throw the other side off. And to do this here would be unlikely. So whatever the response is going to be, such that there is, we'll see. We heard from the Israeli establishment today that they thought the response needed to be significant, but not so as to trigger a regional conflict. And so the appetite from both sides now is clear. We heard the president of Iran, Pezeshkian, say exactly the same thing at the UN when they gathered in New York, that they will not be goaded into a regional conflict. Neither side wants this. Everybody has to save face. So it doesn't look like crude oil cares. I don't think we should either. Not until something actually occurs. And everything that seems to be lining up here doesn't line up to this will become a regional conflagration unless something goes off script. That's of course possible when missiles are going back and forth, but I don't think either side wants to go there.
Dylan, oil does close higher than it traded yesterday into the close. We see here that it's up 1.58%. In the CLX4 contract, it's back to $70.92 a barrel. But it did trade back up into an area where the market keeps rejecting it. We see that the lows that we had in June, August, which then flip over and become resistance here in September, now October. Likewise, the uptrend off of the August swing lows, that's been resistance twice now in the past 2 weeks. Is the play here now until we see some further escalation here henceforth? 99.7 IVR, that's pretty darn high. If we get another spike into 72, start looking to sell some calls or just do it right now. Because I think that you're already sort of late into it.
For. I mean, the thing is, the only thing that I don't understand in this entire discussion is this any hesitancy of any kind. You're got this crazy IV. They're not going to do this. I mean, they're doing what they're doing. It's not that they're not going to do this. What they are doing is what they are doing, and they will do more of this. Doing this is horrible and scary and unsettling and all sorts of negative emotions, but what it is not is a disruption to the flow and availability of oil, and it will not be. So you can talk about who wants this or who wants that or what this is or what that is or what Netanyahu will do or what Iran will do or what they're going to do with the leadership in Lebanon after the assassinations. I don't know. There's going to be it's a mess, and it will continue to be a mess. It will not disrupt the flow of oil.
And it will not be, from the looks of it, a bigger mess than what the markets have already benchmarked and factored into the prices as they stand. So,
and implied volatility relative to itself is at 99. If you do not sell, even a condor, if you don't listen, if you think that I'm too cavalier about the risk, okay, but then sell the condor. For me, I'm long the put, and I'm making money on a volatility expansion in the put, and I already overpaid for volatility going into it. So that's how out of control it is. And so, the only path here is to sell premium and, set your strikes. You manage your risk. I think you sell the calls. I think you sell the calls pretty close to where, within 10% of where it is now. Take a rich payment, but again, to each his or her own. But this to me is a screaming opportunity. Screaming.
I mean, I was looking at structuring, selling a call spread. It's still, the pricing is still not offering great risk reward for how I look at it. So I'm still on the sidelines here and sort of waiting for the markets to rebalance such that I could get a good risk reward structure locked in. And so it goes. But in terms of what I'm looking to do, it's either selling calls or buying puts. Either way, I'm betting on downside.
But at this IVR, why would you not do a premium selling? Just out of curiosity.
It just doesn't add up to good risk reward once you start looking at your max loss versus max profit estimates. It just doesn't give you great risk reward at this point.
I mean, because I just feel like the risk is you buy the put, you're right, everything goes your way, but volatility comes in and you're still down money.
Right.
Or flat.
Yeah. I mean, essentially,
the put buyer's dilemma when you got an IV like this, in my opinion.
Yeah, I mean, you look at this either way, and you're just not getting great risk reward. So, is it worth it to do here? Probably soon, but I haven't been able to really go through a pricing exercise and find something where I go, yes, I will take risk at these levels.
There's part of me that's overthinking this. It's total galaxy brain.
And
It's
yeah,
like,
I might be overthinking it.
No, but it's like, okay, so it's a holiday coming up, so Israel wouldn't strike. That's exactly what they would want Iran to think. And so
Yes.
then they're
I
definitely
mean, he was
during the
giving a
holiday.
speech at the UN when he hit go on the iPhone for the biggest collective assassination in history. So, you know, come on,
And
this guy.
I don't think it's a mistake that when he gave that press conference yesterday, either Bibi was sitting next to the head of Mossad. That seemed like a pretty meaningful signal, right? About and given the context of the conversation, like if you hit us, we're gonna hit you
I
back.
mean, I think the message is, I am the Messiah. I am everywhere. No, you are safe nowhere, and I can kill
That's the
you
message.
at any time. I mean,
Right.
This is that rebuilding of deterrence that we're talking about.
Beepers, walkie-talkies, and the targeted. I mean, never. I mean, and this is the most effective messaging for "I am your overlord, and you live and die at my will" that has ever been communicated, in my opinion.
I mean, I think that this week, 2, 3, 4 holidays coming up, right, Ilya? Sundown today.
Sundown today, depending on how you observe it, it's 1 or 2 days, and then 10 days elapse, and then Yom Kippur, and that's a 24-hour endeavor.
Dylan, I
Well,
think
what
this
would
is
the tactical
pretty gotta
objective
take.
even be?
But it's on a
Chris?
weekend this year, actually. Yom Kippur.
I'm
is on
looking
a
at 2
weekend
days
this
to
year.
expiration, Dylan. Like we're just gonna say that this is that you know, if something happens, it's gonna be short lived, and quite frankly, it's not gonna happen before the end of the week. We could look at 2 days to expiration. You know,
You're
risking
saying just
2.5 to
sell it
make
for
1.
2 days and just let it burn off till Friday on
Yeah.
a Rosh Hashanah bet.
Why not? It's a 99.6 IVR. What do we have to do here?
I know. I love
the typical tasty way would be to go at 45 days. So we'll go to that here, what this would look like with the, we want to go to 45 days, I said. There we are. Let's look at this here. Sell the call spread. I need to do it this way. 1, 2, pop you out here. You know, this is pretty rich too. Forget the next 2 days, right? There could be an attack on Friday, prices spike up. We see on Saturday morning, nothing happens. The market comes back in. 71, 73. You may even want to go a little bit wider just because to get a little bit more space in between your deltas. But you're then risking 2 to make 1. You have a little bit more time on your side to be correct that this is the near-term top. So high convexity, we'll be right or wrong in the next 2 days on the first order. But there is a way to structure this still closer to the 45 in, 21 out, effectively saying that the downtrend will remain, the underside of the uptrend here from the August lows will hold. This little kill box, anytime oil gets into 72, right, this is a place to look to fade it in the short term. Positioning aside right now, because it's a completely different type of trade setup. Both can work simultaneously if they're structured in different time frames. I would think if we get a rally into 72, just you got to treat it as close to the midpoint of the 52-week high-low range. And that's a great place for a condor above 80 and below 64, maybe even a little bit further below 64, like 62, selling the guts down there. But oil with its volatility, Dylan, I mean, right, this is the time when mechanically, I think that you just got to jump in with 2 feet and trust the mechanics of the trade strategies that we know we should apply during these situations and just hope for the best in terms of the probabilistic outcomes.
I mean, the interesting thing is that volatility went to 99 or relative to itself, and the price is still kind of just jaggering around. It's perplexing.
Yeah, I mean, it seems like you have the implied vol telling you people are still fresh off of yesterday's exercise. They're still sitting on tenterhooks here, but nobody's prepared to say that this is actually the go big regional disruption. Let's actually price that in sort of thing. I mean, this is an understandable disparity between the underlying and the options market, where nobody's prepared to say, yes, it's go time, regional war, but at the same time, everybody's worried that maybe it is. And so
I
the
think there
implied
could be a
vol
region.
readings
I think there could be a regional war, and
are
it
off.
still wouldn't affect the flow of oil.
But that would probably have to be discovered with some lag, right?
Fair,
There
fair.
is a freak out function there initially.
Sure,
I mean,
sure.
as we
Like
just
like
saw,
22 February
right?
22 February.
Right. I mean, Russia invades Ukraine. You get a crazy spike in wheat. You get a crazy spike in energy because the biggest producers of both just went to war with each other. And it lasts what? Barely a month. And then starts coming off. Of course, it gives Europe an inflationary jolt that then takes a year to rebase out of
No, the retail side, they exploited it for a year. But yeah, anyway, the point is it's not happening now. I
for the markets part, they were like, okay, but that took about a month.
This is a screaming call spread sale, one way or the other.
Yeah, I mean, it just, for me, it becomes a matter of these spreads need to tighten a little, that this market needs to kind of climb down off the tree where it's been hiding since yesterday. And then that's going to be a setup.
Yeah.
It is the predominant story today. We have oil prices moving up. They did come back down a little bit. We also have ultimately then this port closure still going on. They're trying to negotiate. Bonds looking a little bit heavier in today's session. China continuing to unveil more and more stimulus measures, tweaks, concepts of stimulus, as it were. FXI now another 7.25% gain. We still have not posted a close below the 1 week moving average since the stimulus measures were announced, 147.9 IVR, but you got to be real brave to step in front of a freight train as far as I'm concerned. The past week, China is still going full reflation. They're coming off of a place where, as Vic pointed out last night, going into the last few weeks, the total market capitalization of Chinese equities was less than $1 trillion. And so now that all the stimulus is coming in, it's been effectively a green light for stocks to see significant value expansion. Chinese equities had done nothing in 2024. They're now the best performing equity market in the world, just because of what's happened in the past 2 weeks.
Part of this effort was to quite literally direct official channels to buy local stocks. And this is China, so they were directed not exactly in the most, well, if you'd like, here's an opportunity. We'll provide the funding if you'd like. That's not the tone with which this message was delivered, clearly, and that's not how things in China work. So, yes, of course, it's been a screamer, but also it's important to look at what is the underlying signal here. Is it the underlying signal that investors are voting with their voting confidence with their dollars? Yeah, not really. Or at least not certainly, as you might expect in open and free markets, where what you're really getting is a true signal of supply and demand, or at least you hope to, rather than basically the PRC Central Committee mandating people go and buy stock.
Dylan, do asset prices need to be tied to fundamental logic in this case?
I mean, that you're asking me a rhetorical question.
Yeah.
And so I will give you what you're looking for, which is obviously they do not. That's been well established at this point. In fact, nothing affects asset prices more than central bank policy. And central bank policy is the single greatest driver of asset prices.
Except in China.
With the but again, regardless China, no China, nothing is less relevant to asset prices than fundamentals, especially in any short or even slightly intermediate time window. Especially in a market that's so liquid and so high, so much velocity. Sorry, Ellie, go ahead.
No, I want to agree with you. I mean, in the case of China in particular, you don't have a liquid market, relatively speaking, so it's easy to push around. If officials want to mandate it higher, they will, and they have. We've seen similar efforts when we saw what they did with expanding stimulus earlier in the year, the spike from let's call it April into mid-year, and that of course failed because the stimulus didn't deliver, because in China monetary stimulus hasn't delivered for 3 years. This is not the West's reaction function. The reason this has been so violent is because they promised fiscal support. And if they make good on that, then you have your fundamentals. Everything is aligned. Everything is in agreement. The problem with the hopium here is they haven't said anything specific. They've essentially delivered what was the equivalent of Mario Draghi saying, we will do whatever it takes to safeguard the euro.
Isn't that enough?
For Mario Draghi and the ECB, yes. For Xi Jinping, who's allergic to fiscal stimulus from a philosophical perspective, maybe yes, maybe no. And so that's the question still here. That isn't to say that these stocks aren't going higher, but I wouldn't buy it with your money.
Oh, hell yeah. I'd buy it with your money, and then I'd borrow against that money to buy more of it. Yeah, look at emerging markets for the first time. Dollars coming in. Yeah, Fed rates may not come down as much as people hope for because things are going too well. If it's inflation that's coming about, then who tends to be the beneficiary of that? That emerging markets that dig the commodities out of the ground and ultimately send them as processed goods or finished goods to the West. So at the tip of the supply chain, those equity markets still should do quite fine. EEM here closing at a new yearly high, not just China. We can do EMXC to take China out of the equation. It's obviously not as impressive. It is
it's
unchanged on today's. It's unchanged on today's session, 0%. But it's a day where equity markets.
But it's been down for a few days here.
But this is, we just were 3 days off of all-time highs after a breakout where we've now returned to the breakout point. It's hard to. It's the stimulus pump is primed right now in China.
It's been primed for 3 years. It hasn't worked. The question is it going to work this time?
I don't think that's actually the question, though, right? Because we've seen from every other time that this has been primed, the market runs with it for a few weeks or months. We don't need to answer that question until like December. That's not today's question.
It does, and I agree to your point. If the strategy here is I am going to ride the wave of speculation that China will get it to work this time, that's one kind of strategy. If your strategy is it will work this time, and therefore this has implications elsewhere downwind, other than the very small sandbox that is the Chinese stock market, that's a different idea. Hence, you see that even in the past 5-6 days, as Chinese stocks have surged, we just looked at it a second ago, emerging market stocks over the same period of time are down when you exclude China. U.S. markets are down when you exclude China in the same period. The Australian dollar, a proxy for Chinese growth, is down in the same period. Copper is down after a spike in the same period. So everything that isn't the insular sandbox that is mainland stocks, which the PRC can mandate, is telling you, we're not so sure. Now, that doesn't mean they can't continue to push mainland stocks higher. They can. But what you're doing in doing that, in buying that at this point, is you're swimming against the current of opinion outside of China, as seen in the Aussie dollar, in copper, in other emerging markets, as we've just listed. And so who knows how long you have there? Maybe a while, maybe less. They're rallying on a rumor. The Politburo didn't say anything. They didn't give any specifics. They'll squawk something a little bit different in a week, and it goes the other way. Or they won't. But I don't want to take that risk. That seems like an invitation to get run over.
Dylan, in my world, if Blue Horseshoe loves Anacott steel, I'm buying Anacott steel. And right now, if the CCP wants to pump,
you're talking my language.
if CCP wants to pump the bags of Chinese equity holders during Golden Week to paper over the horrible news headline that a nuclear sub may have sunk,
Yeah.
come on, this is a propaganda machine. Of course, that's what's going on here, right? We have this national crisis. This
I mean, my only question.
I mean, they've pumped it. It's there, right? Like it's up
That's
a lot.
my concern.
It's
I just don't know enough. With oil, I'm much more comfortable taking the position. That's only because of recent experience, having increased my confidence. I would love to buy China. I wanted to buy China a couple of days ago. You two talked me out of it. My only question is, should I buy it now?
I'm effectively short
Don't give me that furrowed brow. What's that?
I'm effectively short China because I'm short the Australian dollar. And I'm not going to say it's working. It's very preliminary yet. It's starting to work.
If there's pullbacks into the 1 week moving average, I think you got to buy dips right now until momentum breaks.
Would you buy it right now, no matter what? Blind
I wouldn't buy it.
madness?
I wouldn't buy it right now. I would wait on a pullback because it is a little extended from the 1 week. But if we see tomorrow that, like, look what happened 2 days ago. We got a breakout here. We had a day of pause. We get another day tomorrow where we just kind of like slide sideways. I think you gotta be long on the other side of it still. It's a momentum play. That's what you're rolling. You're rolling the dice here. You're just seeing how far can it go and how long can I take the ride for.
Right. No, I completely agree. If that's what you're doing, if that's your strategy, Godspeed. That's not the kind of trade I want. But that doesn't mean that it's a bad one or that the idea doesn't make sense. You've already seen what the PRC can do by squawking in the right direction. Nothing is to say that they're going to stop squawking in the right direction, and how long the external market's pessimism in this, because that's palpable, how long that takes to sort of take the wind out of the sails here. Who knows?
Is that IV rank, Lodge? Is that a real number, that 147? Am I seeing that correctly?
You are seeing that correctly.
Yeah, I mean, if this is what you're after, basically saying, look, momentum here is strong. They can keep talking this up until they can't, and I'll be long as and until. Sure, that's just not the kind of a setup I look for.
Dylan, if we want to make the bet right now that you're still going to ride up that 1 week moving average until something changes, that's 32.94. The 44 days to expiration, selling right around the 32.94 area, right? That would give us perhaps a 64% probability of profit. You can risk a little bit less than 3 to make 1. You could change this ever so slightly, give yourself a little bit more, and it goes about closer to 3 to 1 in terms of risk to reward there. Either way, though, that's the key feature here. If you are looking right now and you're thinking about getting exposure to Chinese equities through something like, or in a manner consistent with the Tasty methodology here, the 45 in, 21 out, there is a November 15th expiry that tomorrow when the market opens will be at 43 days to expiry. And even so, if you're getting a 60 to 70% probability of profit and you're getting a 2 to 1, that's a pretty decent way to do this in a riskified manner without having to overpay for the, long call exposure, as it were, because if the market, let's just say, rallies up and then stops, you can still make money on the short put spread. If you're long the call spread and vol comes in and we keep rallying and vol comes in, people know this with the earnings, right? You've seen where you buy out of the money calls for earnings and the stock price goes up and then your earnings expire close to worthless. That's the theta decay. Think of it in the same manner here. So I think the short put spread is better to capitalize with the 147.7 IVR. Don't pay up for the premium. There's a little bit of liquidity here. We can see the open interest across the strikes that we've obviously just blown through very quickly here in recent days. So have to imagine that more liquidity is going to start to come in on both the call and the put side, particularly on the put side as we begin to move up more and more. Obviously, there's healthy volume for the calls 10, 15, 20% higher than where we're currently trading, which I suppose is to show that there is still a good deal of belief out there that this market will continue to go up. Guys, let's move the conversation forward here, though. We've been talking a little bit about Iran and China. Unfortunately, we can't round out the axis of evil with a story about North Korea. As far as I'm concerned, we can talk about the energy sector performance here today. Your top performing sector is SMH. Your worst performing sector on the session goes to XRT retail. It's really a tale of two different outcomes right now, insofar as semiconductors and retail are probably two of the things you want to see going hand in hand. So if it's speculation about AI or growth, there's not a consistent drumbeat there on this Wednesday session, although it's a Wednesday session with not much volume in the markets. Guys, a few weeks ago, going into NVIDIA earnings, there was an SMH iron condor that was put on. Granted, it wasn't the sexiest trade in the world. I don't consider iron condors to be the most appealing thing. You know, you make your money with high convexity effectively, at least as far as I'm concerned.
You know where I stand on this. Directional. But
SMH, for all the warts and bumps it went through at the start of September, I was ultimately a few days ago able to take it off right at the midpoint of the range where it's been trading from the July high to the August low. And with a 55 IBR, I can't help but think this looks like a pretty good spot to put that trade back on right now. October being a month where seasonality, really, you can pick and choose your narrative there. Typically it's good, but during election years it's not. But those good years, when it's good, it's really good. Well, what if we're 20% plus after September and it's not good? This seems like a good place to chop and grind. Volatility is elevated for the rest of the month because of the presidential election. Why do we need to take significant directional bets outside of any of the indexes? And why not just look for range trading here now for the next few weeks and capitalize on the vol while we have it? Ilya, what should we do with names like this with the volatility as it persists?
I am a lot more interested in what's going on in the NASDAQ at the index level than I am in the sector ETF. I mean, this doesn't really... This shows me a little bit of a reflection of how NASDAQ looks. I mean, obviously, there's the July top, there's the shallower August top. This is coming off that August top, much like NASDAQ is. And it does look like the near-term sequence of higher highs and higher lows has been violated here. So you maybe have some room for a little bit more of a pullback. But ultimately, I think the index just provides a cleaner reflection of this same thing. I mean, the price action there is very analog. Just look at the past two candles on or three candles rather, on what you see here. You initially attempt to close above August's high. You do that. The following day, it turns out to be a false breakout. You come down and you close back under August's high. Since then, you continue lower. The past 3 days, you get a pause, breakdown, and then today you get a retest of the underside of the preceding green candle, as if to tell you with clarity, hello, yesterday's breakdown, that was the real move. This is the retracement now. The next leg is down. Now, if you look at NASDAQ, it'll show you a very similar picture, just a little bit cleaner. So I like the ability to do this with futures overnight, the flexibility to be able to get out if something goes haywire, especially in such a weird geopolitical climate. That's attractive. But look at this NASDAQ chart. It's the same thing.
It's a NASDAQ that's finding support on its 1 month moving average. It was a bearish engulfing bar yesterday with an inside day today. And I'm reminded, you mentioned the lack of follow through. I don't know. Maybe it's like a spidey sense kind of thing. But and it also could be my permeable pro-American, I'm a patriot bias speaking as well. There was a topping candlestick pattern here in gold. This is just purely instructive. If something is going to be a topping pattern, if something's going to be a bottoming pattern, there is a very specific definition to how things should proceed, right?
That's
Words have meanings. In the case of an evening star candlestick cluster, big green bar, doji or shooting star, red bar that encompasses at least 50% of that first green bar.
Textbook.
But you get a doji as the next candle. That's not follow through. And then sure enough, inside day, big green day. Okay, so this wasn't a top.
As different from the NASDAQ, where the follow through has already materialized.
But
that's exactly right.
That already happened, right? We're talking about the last 2 days of candles. Yesterday was a bearish outside engulfing bar. Today is a green day.
It was the previous engulfing bar that starts us though. The one like SMH, which shows you the break above August's high fails. It's that bearish engulfing. And then you get a pause and follow through. In an SMH, it's not an engulfing because there's a gap.
No, right, the gap.
And so with the gap, if you were to kind of mentally fill that in, that's more like a dark cloud cover, a candlestick pattern, or a Harami candlestick pattern, were this to be continuous. But it's not. There's a gap. So with that in mind, what are you left with? Basically the same thing, that you try to get through August's high, you fail and fall back in, and on that failure, you follow through. Now, maybe you don't follow through tomorrow, maybe not the day after. I suspect you do, but let's see. In any case, I'm looking at this and saying it's working to the downside until it's not.
Dylan, as a way to capitalize perhaps on a market that's going to chop around here for the foreseeable future, maybe that's what October has in store. Volatility stays elevated.
I mean, yeah,
this
seems like a tasty trader's delight, right?
Yep. You know what? It worked at the end of August, ahead of the Nvidia earnings. There was a rough patch there. Don't get me wrong. There was a really rough patch there. But then the market bounced back and we ultimately settle in. And I'm one of those people who, if it's not broken, don't fix it. I'll keep going back and back and back. It's like with the ES call spreads earlier this year. Like it worked, November, December, January, February, March. April was crappy, but then the conditions arose for it to work again in May, June, and then not July, and then August, not again. So then I backed away for a little while, right? But until I get punched in the face 2 months in a row trying something, there's no reason not to do it again as far as I'm concerned. Here, it's, again, about 2.5 to 1 for a 60% probability of profit, where you're looking at a market that says we're not going to break the lows that we had in August or the highs that we had in July, at least for the foreseeable future. 21 days in terms of a trading calendar, that's going to bring you, roughly speaking, to the end of October, which means you can take this off right before the election, before the reason why all this volatility is baked into the cake finally pops off. So I'm going to be sizing this up for tomorrow. I like going $15 wide from the guts to the wings. That's selling the 220, selling the 270, going out and buying back the 285 and the 205 on the calls and the puts, respectively, 60% probability of profit. It brings some directional neutrality to my overall composition, Dylan, which, again, when you're bringing new strategies into your portfolio, the constant consideration is how does this impact my beta-weighted deltas? How does this impact the correlation of all the assets that I'm holding? Because you don't want to inadvertently put 10 eggs in the same basket when you're laying on these new trades. So for me, because I have a net long delta bias for the most part, this is something that actually helps because it differentiates my time horizon and my holdings. So I'm very comfortable.
But I just like I feel like it's, and not in a negative way, but I feel like the oil discussion, the China discussion, and now certainly the SMH discussion, you're looking at the same dynamic, which is expanded volatility and a churn. And you can pick a side or you can run a condor and do a 45-day, 21-day entry and exit. I mean, it seems like a good time to learn how to be a tasty trader insofar as there's volatility to be had. And it's not,
there's certainly that. There's certainly that. If there was a time to look for vol extraction, these are the readings you want to see. I would only caution that we don't know that the vol expansion has ended just because the geopolitical risk has ended. We have a bunch of U.S. economic data now in the window tomorrow and Friday. That is of consequence. And we saw earlier this week when Powell spoke, given what he said, which was aimed at cooling the market's dovish jets, stocks didn't like it.
Mm-hmm.
But we
and
also
the bond
know
has
that
been
U.S.
a mess.
Yes. We also know that the markets took the Fed's message as reflationary, which means they don't want to hear from the Fed that they're going to cut less, and they don't want data that's going to tell the Fed to cut less. Meanwhile, the data has been good.
Who's the day that you speak of, by the way? Am I part of that day? I'm fine with the Fed telling us this. This is fine. Who's the day here?
Look at the response from the S&P 500 at exactly the moment that Powell spoke on Monday.
That's fine. That's nervous algorithms who are seeing words on the screen and don't have the.
I mean, you can say that.
I'm going to say that
just like I can say they. But the price action is the price action.
What do you mean, you people?
How does an algorithm get nervous?
That's right.
They have
it's the nervous algorithms. Don't worry about it. It's an unfortunate byproduct of the super collide. Nervous algos.
Though, you see these large language models read the headlines that come out and they impute certain things based on the speech. Like you can go on your
suggesting that their personality profile tends to be anxious and a little nervous. Maybe
they're all
laid back. Maybe they're like surfer bros.
They must have been trained on my content.
Maybe they're like, hey.
No. Sorry, no, that's not how they
they're
are.
Nervous.
We both know that. They're nervous as hell. That's why they're like in and out of the market in 6 nanoseconds these days.
They're hopped up. They're ready to go. They're ready. They're real. They're ready to do whatever they need to do yesterday.
Dylan, by the time the nicotine from the Zyn touches the inside of your mouth, okay, they've already been in and out of the market 50 times.
By the time you light your first Marlboro Red to think about what you want to do next, they've already come and gone 50 times.
In and out, already there. Regardless, though, innuendo aside, look, I think this S&P chart today, we have that bearish engulfing bar yesterday. Doji today at the 1 month moving average, holding above the September highs. Guys, choose your way, Western man. Dylan, tomorrow's price action. Are we buying here and saying that the 1 month moving average is going to hold? Or is tomorrow the day that it breaks and stocks finally crack heading into non-farm payrolls?
In what world does a competent human go face first into the direction of the equity indexes 2 days, with the jobs number on Friday, and this level of sort of the absence of clarity that we currently have, and the absolute garbage from the bond market the last couple of weeks? I don't see how you do that. And especially when you could just be non-directional and sell volatility. I can't have any part of it. I have no idea. It's a mess. I don't want anything to do with that. I'll sell your premium.
Any part of it. Okay.
I can't have anything. I can't attempt. I don't even bring up my name.
Okay.
No, I don't know. The stock market is the most mysterious to me at this point in terms of its direction. I'd sooner have an opinion on Mexico.
Okay, Ilya, I think I know what you're going to say, but let's give you a chance.
I'm short because it's working. S&P is down off the highs. That's making money. NASDAQ is down off the highs. That's making money. The dollar is up off the lows. That's making money. About the only place where I have short dollar exposure is against the yen, because or a long dollar exposure sort of flipped over, because the yen is clearly not wanting to follow through on those gains after we have the change in prime minister. The yen initially rallied. It's since come back in. So about the only risk-on exposure I have, sort of traditionally risk-on exposure, is I am long the dollar against the yen on the spot side, because my yen exposure now lives on the spot side after the indignities of trying to manage risk in 6J at the beginning of the year. So I'm effectively short 6J, but I'm doing it on spot side. Other than that, I am short the euro, short the Aussie, short the pound, long dollars, short via verticals, MNQ and MES.
You want to buy
and
the
short
stock
Europe
market
also.
tomorrow. You want to buy the stock market tomorrow. I could tell from the tone of your voice and the way you asked me the question. You're like, let's do this. I can see it in your eyes.
Did it work for those people previously? Yes, it did.
Yes,
So
it
we'll
did.
try to, yes, it
Yes,
did
it
actually.
did.
Yes, it actually did. Okay. Yeah, you know what? I'm far more compelled by something one of our loyal viewers sent in. If you watch us on YouTube Live, we forgot to say hello. From Stephen Powell, Madman's Delight trade.
Ooh,
Buy
yeah.
the 6JH593 DTE 0064 put. Let's go. Okay, so let's go see this. The 93 DTE 64 put. 64 put. Well, obviously we're not going to, the yen's not going to zero, so like that, don't ignore the max profit there. But it's a compelling, this is something that I do want to talk about, because the last few weeks there has been this joke, not joke, that we're potentially talking about a return of the yen carry trade. The positioning in the markets suggests that there's no risk there to that right now. Fundamentally, in middle of July, right, just to backtrack here for a second, you have one of the largest net short positions ever in the yen. It's now a net long position still, so that's not a significant factor. The carry trade's been completely unwound. To that end, though, last night, the new Japanese Prime Minister, Ishiba, effectively said that the market doesn't need to worry about the BOJ anymore. We have this inflation data that's just come out from Japan showing that headline inflation, core inflation, month over month, starting to slide back into negative territory. So the BOJ hikes, and we're now getting more deflation. They're probably putting this back in the can for a little while. If the Chinese government is pouring stimulus, if the BOJ is sending signals from a political channel, at least, or at least the political channels are telling us that the BOJ can't do more, the Fed's cutting rates, oh my gosh, there's supply chain issues. This is hugely inflationary. 2022 is a freaking nightmare for the yen. 2023 and 2024 were freaking nightmares for the yen, okay? In part because of the rise of commodity prices. This is a currency of an island that imports everything. 90% of their imports for energy come from abroad. It's all valued in dollars effectively. Why isn't this going back down to where we were earlier this year, guys? This feels like the high convexity macro layup trade for the rest of 2024.
I mean, I'm essentially short yen here now, and I've been so I had it on before the election news, and the Shiba news didn't spook me out. I'm glad I held on because I thought ultimately it was an election that gave a status quo, not status quo change, which would have been what would have happened if the more dovish candidate emerged. So I'm happy with this. I think this looks right. It certainly lines up with the reflation idea. Certainly lines up with what we've seen in gold, in the curve, in copper, in break evens. I just don't extend that conversation to equities.
Because you're still
because they're
Soviet
going
at heart.
down.
You're still a Soviet at heart. That's why.
And as soon as they stop going down, I'll buy them.
You know, I'm watching The Americans right now in my free time, Ilya. You and I have to have a conversation after this.
I couldn't make it past the second episode of season 1 because I didn't feel that they were Russian enough. It didn't seem credible.
Tomorrow, Dylan, you know, you mentioned that Momo monkeys like myself are looking to buy. To Ilya's credit, one of the structural issues that we see here in the short term is when we punched through the highs that we had back in July, we started to treat the former highs as support. And since then, we pulled back in there. So if we can actually see tomorrow, you get through 57.90 or so, you pull through those earlier highs that you had on July 16th, 57.85 to be exact, you have a lot more of a compelling case than to head into the weekend going up after non-farm payrolls, because this is the market going through a whole, is it good or bad that the Fed's cutting?
Right.
Forget the context of the current conversation. We know that one thing that works, it's been working for years. Prove me wrong, right? The market needs to prove us wrong. If it's a good jobs report and stocks decline coming out of a good jobs report, you buy the weakness every time. Doesn't matter that we're not going to get the rate cuts. That means economic growth is going to be higher and will deliver more than whatever the rate cuts would have offered. It's a good thing. I insist it's a good thing that more Americans have jobs. I know, sue me. But I think it's good for the equity market too. So if there's weakness on the other side of it, I would like to buy it, Dylan. You're right. I'm going to do this until I get punched in the face. Although yesterday,
but you're going to buy it going into the number.
I'm going to buy them coming out of the number on out of a week. Well, we're doing a few things here. I'm going to be buying one.
Plus, not to mention, I'm going to do that yen madman. Tell our viewer, I'm in on the madman there. But anyway, back to the equity market, the big show here.
I think that we have a legitimate chance of a bounce tomorrow. I think staying long against today's low is a way to scalp. If you want to scalp tomorrow's market, that's how you do it. You treat today's low as a low. If you're out of there, you've then also broken below the initial September high in ES, and that sets up a more meaningful pullback towards probably 56.65, 56.70 heading into non-farm payrolls, which also then could be a fantastic setup for the non-farm payrolls number, whereby if it is good, there's so much fear already baked in heading into it, then it becomes a more reasonable technical buying opportunity with a better risk to reward at the support trend from the August and September swing lows. Either way, though, my long-term exposure, I still own the 6,000 calls. I am perfectly content looking to add more deltas on pullbacks right now, because the two things that just occurred have not changed that make me so bullish. Anytime the Fed's cut rates, when the stock market's been within 2% of all-time highs with the S&P, the market trades higher. That's number one. And number two is the Fed just cut rates in a quarter where we did not start a recession. And momentum's good. 2.5% to 3% real GDP. Anyone would have signed up for that years ago. That is the case that we need to talk about. Years ago, when the Fed started hiking, if you said by October 2024, the unemployment rate's still going to be below 4.5%, inflation's going to be with a 2 handle, and stocks will be at all-time highs, no one would have believed you. No one would have believed that story. So yeah, Dylan, things that never happen are happening all the time, and we've never seen 6,000 S&P before. So I will be a bull. I'll be a believer. We got a lot of easing in the pipeline, guys. What
if the number comes in light, Papadopoulos?
I am out. Screw the U.S. economy. American workers are done. Okay, I'm joining.
Nobody's talking about the bond anymore. You're going to try to get out of this hour without a bond discussion of any kind?
We mentioned bonds, port strikes, and oil prices moving up. It's a drag in the short term. I'm not ready to roll my positioning, but for ZBZ4, I have my plan here. I'm just sticking to my plan. My plan is that 45 days to expiration instead of going 45 in, 21 out. We're going 45 out, and then we'll be going 80 in and continuing to go out to the longer duration to buy time right now as the market perhaps experiences some conflict with the reflation idea. But if reflation's correct, bond's going to lose, but then everything else is going to do well. Silver's going to do well. Gold's going to do well, right? Stocks will do well. So yeah, this might take some lumps, but the vast majority of everything will be moving in the profitable direction. And if I'm wrong, then, well, hopefully it's deflation and not inflation outright. Otherwise, everything is screwed. And I got some splaining to do to my wife. Where did the money go? Why don't we have a house?
Nobody's talking about the first female leader in North American history, by the way. We didn't even talk about that.
I mean, we've known that, though, right?
Listen, it officially happened, okay?
It did officially happen.
You see the picture? It was a nice picture.
It was.
And then I know you own the market. You own the Mex. At least a couple months ago, you were EW.
Oh yes, my long-term view is very.
Are you still in there?
Not the short-term tactical, but certainly the longer-term allocation. Absolutely.
Anyway, you're trying to do your job, Chris. I'm sorry.
I'm really not.
Okay.
I'm not, because overtime's out of time, right? So this has been the episode for Wednesday, October 2nd, 2024. For Dylan Radigan in Milan and Ilya Spivak in San Francisco, I've been Chris Vecchio in New York. We'll be back tomorrow, same time, same place, here on Tasty Live every Monday through Thursday, 4 p.m. Eastern, 3 Central. Although because it is Thursday, it is the abridged version. 4:30 Eastern tomorrow, it's the prediction trade. We're going to be having on Alan Lichtman. Have you heard of the 13 keys to the White House?
This is going to be so awesome.
He's our guest for this week, and he's fighting with Nate Silver, so we're going to use it as bait to get Nate Silver on for next week, hopefully. So join us tomorrow. Otherwise, after this break, Ilya Spivak's back with Macro Money. Stay tuned.
See you there, folks. Stock markets take a breather after yesterday's literal fireworks as Iran strikes Israel and the markets panic. But we are once again facing a busy macroeconomic calendar with data on the hopper tomorrow and, of course, on Friday that might bring us back to volatility. I'm Ilya Spivak, head of Global Macro here at Tasty Live, and this is Macro Money. We're going to unpack all of that here. We spent yesterday in the wake of Iran's attack talking about how that might extend into the release of the ISM report, which comes to us tomorrow. Today, we're going to take a look further afield and see how all of this fits with what is probably the biggest piece of event risk for the week, September's U.S. jobs report. So as ever, the question for us, not so much the academics of the situation, whether this or that definition of jobs growth or the unemployment rate or this or that is real or not real or well-founded or not well-founded. As ever, our question is about the market's reaction function. That is to say, if we were to get good or bad data, would stocks like or not like it? And so with that, let's consider where we stand and just do a bit of inventory about what's actually occurring here. So we know that the markets concluded in early July when the Fed began to signal that it's ready to cut rates, that they felt the Fed was behind the curve. And this much is readily on display when we take a look here at where the July top is in the S&P. We can see very clearly here that what happens is into that July top, you are looking at a building of Fed rate cut expectations for 2025. That's the yellow area that you see there, even as the outlook for this year, for 2024, in the gray there, is holding static. Now, why is this occurring, and why is it that when the Fed actually starts to talk about needing to cut, which occurs right here as Fed Chair Powell testifies in Congress to this effect, why is it that this is a downturn, and why is it that going in here, all these rate cuts are building out? You can see the overall tally of cuts is growing from here, where it bottoms at negative 76 basis points. It nearly doubles to the start of July, where this actually occurs. So why is that? Well, look at the way that economic data was performing. And we can see that from mid-April and into early July, where the Fed makes its announcement and very clearly bottom ticks this, which we'll get to in just a sec. In just a second here, the Fed says right around here that it's prepared to go. Notice what U.S. economic data is doing in this period. This is a Citigroup index that measures its performance relative to expectations. It's deteriorating, and as of early May, it's actually tending to undershoot relative to baseline forecasts. So the message that the markets are receiving is that the economy is doing less well than expected. So not surprisingly here, the markets say, well, until this point, the Fed is reluctant to cut. It's worried that deflation isn't happening fast enough. So the markets say, well, that means more cuts next year because you're going to realize that you're late because the economic data is already deteriorating. So when the Fed actually makes this statement here and gets the conversation going and focused on rate cuts being not just some future thing, but imminent, at that stage, the markets go, well, you've finally found the weakness we've been looking at for 3 months, and ostensibly you've recognized something that is so ominous that you've been compelled to act. And that's not good news for growth. And so what you see here is stocks come off as things get more dovish. Now, fast forward, and what you find is that some of those fears about the strength of the U.S. economy and the motivations then for the Fed to do what it was doing at that stage, that's turned out much more well supported. We just looked at this a moment ago. Notice since July, there's been some anchoring in the way that data has performed relative to forecasts. And then late August into September, the data actually starts to get on the mend. So much so that now it's actually crossed back over the zero line, suggesting that for the first time in 5 months, U.S. economic data is tending, or has now a tendency, to beat forecasts as opposed to undershoot them. This is a very different sort of environment. Now, notice here, if the markets were going to be concerned that the Fed is scrambling because they've already missed the window, this is not that narrative. This is a narrative of a U.S. economy that's looking stronger than anticipated. We see this in the latest batch of PMI numbers from S&P Global. Notice here, we've been basically holding at the high from May on this composite index. And of course, as ever, this is done in the logic of PMIs. So above 50 is growth. Below 50 is contraction. The further you go above 50, the faster the growth. The further you go below 50, the faster the contraction. And what you find here is that you had a jump in U.S. economic growth back in May. That's here. And then for the subsequent 4 months, September included, you've held those levels. And that's because the service sector, the largest part of the economy, has shown up more robust and offset weakness in the manufacturing side. Just earlier this week, you began to start seeing the ISM version of the same kind of PMI data. This is from the Institute of Supply Management. So far, we've had the manufacturing numbers out. Here is the forecast for the service sector numbers due tomorrow. Now, we can see here the manufacturing side was a little bit lighter than expected, ever so slightly, 47.2 versus ultimately the consensus forecast at 47.5. But this is holding generally steady, and as we discussed on the show yesterday, the internals of this report actually looked quite positive. We saw the first decline in prices in a year, or this year. The last time we saw a decline in the price index was December of last year. We saw welcome signs in lengthening delivery times, in falling inventories, in the production index almost coming back to growth, in new orders falling at a slower rate. All of that seemingly suggesting that the under the surface dynamics below this number are generally starting to look a little bit better, even though at the surface you're basically holding steady. But weakness in manufacturing need not be a problem for the overall story here, at least from the Fed's perspective, because of course they're judging this at a very high macroeconomic economy-wide level, because as we just saw here, we had the deteriorating manufacturing from S&P Global. It was much more dramatic than what we're seeing here, where things are basically steady. But as long as services is going to be strong enough, the overall growth rate holds up. Services, of course, accounts for between 70 and 80% of the economy. So when we look for what's likely to happen here with the service sector index, as long as we get somewhere within the realm of expectations, much as we did with the manufacturing side, we again get a story of an economy that's steady. And again, looking back here, this is what steady means. Steady at solid levels. It would be much the same sort of conclusion here were you to land, give or take, as anticipated. At the same time, the Atlanta Fed's closely watched GDP forecast, although it's ticked a bit lower to 2.5%, still well above where consensus expectations are, and still looking at reasonably strong numbers. So we're still looking here at a situation where, despite the fact that we've downticked from 3 to 2.5%, if this is going to be right, then we will have grown 2.5% in the third quarter after a 3% gain, stronger than expected, in the second. That's not bad news. That's good news. That's relatively healthy. And of course, the markets have reasoned that we are going, against this backdrop, to be adding stimulus on top of an economy that is not doing poorly. And of course, what that means is that we are, in essence, looking at a situation where if the economy were shy of demand and the stimulus, that is rate cuts from the Fed, if that were to be something that was looking to counteract some sort of weakness, then we'd be looking at a story of relative positivity and a story of inflation coming up from low levels. That is not what the markets are saying. They're saying what these rate cuts that the Fed has now initiated going to do is stoke reflation and give us once again something that might limit the Fed's appetite for rate cuts. And you find this very clearly here in what we've seen over the course of September, as the Fed really started to signal that the move in last month's policy announcement will be to do the jumbo 50 basis point cut, which of course they ultimately delivered on. We see gold higher. We see the spread between the 10 and 2-year yield, the slope of the yield curve, steepen because long rates rise, even as the markets position themselves for a more aggressive Fed, because this is being viewed as reflationary. The expectation is, well, this will make for a need to have higher rates in the future. We see that the 5-year, the 10-year break-even rates here are at the highest that we've seen them since back in June. So all of this seemingly speaks to higher inflationary pressure. And then, of course, we posit that alongside now expectations that the Fed is going to cut by a further 50 basis points this year, once in November, once in December, ostensibly, and then another 115 basis points are baked in for next year. That's about 4 cuts and a 50-50 shot at a fifth, and ask ourselves, well, if the economy is doing strong, if we are looking at the markets endorsing that and saying, well, this will be reflationary then, given how much easing the Fed is now expected to do, if we were to get data suggesting that indeed there is a disconnect, well, then the amount of easing that the markets expect might be diluted. In fact, you already see a little bit of that starting to happen. And of course, you already see a little bit of weak need dynamics from the stock market against that backdrop. Now, of course, geopolitics is a part of that decline as well, and we'll take a look at it in just a second. But nevertheless, the creep is starting to occur. And if indeed this is now the way of things, and U.S. economic data has scope to beat relative to forecasts, then our expectations for what this U.S. jobs report that we have coming up on Friday, the expectations for what that is going to give us here, those might be a little bit light relative to what is actually liable to occur. Now, let's take a look at what those expectations are and consider where the markets are biased. And what we find, of course, is much as we did with the PMIs, much as we did with the ISM numbers, relatively steady conditions. Here is jobs growth expected at 145,000 non-farm payrolls rise. That's a barely noticeable uptick from the 142 recorded in August. Jobless rate seen holding unchanged at 4.2%. So steady as it goes here. But again, if this is now the way that things are going to trend, then there's upside risk here. And if there's upside surprise risk, well, then we may well see this move further upward. And of course, the operative question therefrom is, what does this mean for stock markets? Now, we already had a bit of upside surprise on this data this week. Job openings numbers higher than expected. 8 million versus 7.6 million, or 7.67 if we round it. If we round it, expected. The ADP measure of payrolls growth. This is a private sector estimate. 143,000 jobs added in September, according to their numbers, versus 120,000 expected. So there's already some signs that jobs data is outperforming forecasts. If that's what we end up seeing here, and these numbers register higher, this may well shift into a still less dovish setting, because this starts to look still more reflationary. And now the question, does this pose a risk for stock markets? Should this be something that we are concerned about? And here, the main sort of consideration, as you might anticipate, comes from sort of relative positioning. It isn't so much that it is bad news that the economy would be adding more jobs than expected. That's certainly not the case. It is more a question of whether the markets are prepared to take incremental further exposure on risky assets on that basis, and whether that is something that is going to be an upside motivator or a downside motivator, not so much for the economy, but for risk taking. With that in mind, it is important to consider, as we have earlier this week, when Fed Chair Jerome Powell came out and said pretty much this to the markets, and said, we don't need to go fast on rate cuts. We're facing a dual risk, not a singular risk just to the jobless market now. We're not singularly focused on labor conditions the way we were singularly focused on inflation from 2021, 2022 through basically to the middle of this year. No, we are looking at a balanced set of risks where we don't want to let inflation reaccelerate, and we don't want any further pain to labor market conditions. So we are cutting, but by no means are we in a hurry. And of course, he asserted loudly, as a matter of fact, that the Fed doesn't think that they're late. They don't think they've fallen behind the curve. And when those comments came around, stocks didn't like it. Now, one reason why that might be is, as we've talked about earlier this week, this is a chart from The Economist, courtesy of data from the IMF. We find that this rate hike cycle has been unique relative to every single other one since basically the advent of the modern financial system, when the dollar depegged from gold in the early 1970s. Take a look at this chart. This represents the change in the Fed funds rate. So this is rate hikes. And then this is the change in interest payments made by non-financial firms, so non-banks. In other words, this says when the Fed hikes rates, companies have to pay more to service debts because rates are higher, the cost of money is higher. That's what slows the economy. That's what brings down inflation. This is why rate hike cycles tend to be accompanied by some degree of economic weakness. Notice how this current rate hike cycle vastly differentiates from every other one. Whereas payments on interest by the private sector increased in every other instance, or at least stayed steady. In this case, they actually fell. Now, how is that possible? Well, we had rates very, very low and lots of non-traditional stimulus like open-ended QE in the wake of COVID. At the same time, the global economy was shuttered. So companies didn't really have a whole lot of money to spend, relatively speaking, with everything offline, but lots of opportunity to borrow for next to nothing. And so the cash reserves that they've built up were substantial. That's how you now end up with a situation where even though rates have gone up, interest outlays have gone down because companies are flush with hoarded cash after the pandemic. But those loans tend to have a refinancing window of 3 to 5 years, which should bring us to right about now. If the cost of capital starts to reset on these loans as we go into next year, that would be about a 5-year window, then even as the Fed cuts rates, companies are facing higher borrowing costs. The Fed would need to essentially cut back all the way to zero for that not to be the case, even as it's cutting, because, of course, the rates that were available in the heart of the COVID pandemic were essentially free money. And we are very much not there, even if the Fed cuts twice the amount currently expected next year. So what we have here is a palpable concern that as these refinancings occur, if the Fed were to cut less, they would present a greater risk. And perhaps that is why the markets are looking at the rate cut tally and saying, we prefer more versus less. So if this data is going to surprise higher, as has been increasingly the case, then the S&P 500 here might get a little bit soft, just as it tests support at about 57.21, having pulled back off the high just above the 5,800 level. And if we can push through here, and then also the highs that we see here going back to August at 56.65, well then this is going to look not like a pullback, but like capitulation and a reversal downward. And that is macro money for today. As ever, we are here every Monday through Thursday, right after overtime, a show that I co-host with Dylan Radigan and Chris Vecchio, looking at the Wall Street close and where things are likely to go there from. I am on every Wednesday with Victor Jones for The Price of Truth. That includes today, certainly, so come check us out. Back on with Chris for Futures Power Hour on Fridays, on with Victor and Tom for First Call on Sundays, writing for the News and Insights portion of tastylive.com, and commenting on the platform formerly known as Twitter at Ilya Spivak. Thanks very much for joining. See you soon.
It's options. Jive.
Tomas, you are correct. It is time for an option jive. But before we do, Tesla numbers, the moment you've been waiting for, Sadaf, the moment we all been waiting for, Tesla numbers came out. Tesla's down by around $9 to 248 and change. Nasdaq's only down 29. Even the S&Ps are down 10, and volatility is down a nickel. Buy the rumor, sell the news, Sadnov.
Yeah, well, I think I'm a little short Tesla here. Well, we'll see. I don't know. Anyway, we're running late. It's 8:16. It is Wednesday morning. I'm Tom Sosnoff. He's Tony Batista. This is Tasty Live. Thanks for spending your morning with us. And hopefully the rest of the day. Hopefully you enjoyed Pete and Frank. They kicked off the new show this week, so we've extended Tasty programming. We start now at 6:30 in the morning Central Time in Chicago. We actually start at 1:30 in the morning Central Time in London with Angie and Rich. And then we kick it over to the Chicago team at 6:30 a.m. Central Time with Frank and Pete. Then we come into Tony and myself at 7 and Minetta. And then we go all the way to Victor Jones. I think we should change the name of Victor's show to Jonesing It. Or, yeah. I'd rather have it as
okay, Boomer
Jonesing than The Price of Truth. But we go all the way to Victor Jones' show.
Jonesing it. It's off the hook.
Yeah, so I'll figure it out. I got to brand this kid. He needs work. He needs help. And Victor Jones going for another 30 minutes at night now. So we're going all the way until all the way to 6:30 Central Time. So we start at 6:30 in the morning, finish 6:30 at night. 12 hours a day of programming in Chicago, followed by 5 hours out of London. All right, let's do this. SMCI.
1256 was the contract you were looking for.
Oh, 1256. Right. What did I say? 1053. Yeah, I'm out of my mind.
Yeah.
It's been so long. 1256B. You're absolutely right. 1256B. I apologize.
It's okay. I was
my bad.
reminded too. I didn't get it.
Yeah. SMCI just did a 10-for-1 stock split. So it's kind of weird to see a stock do a 10-for-1 stock split at $400. Because rarely does a stock go back to. Let's see, I have a position on it.
Well, it was $1,000, Tom, when they were talking about this.
I understand, and now it's a $40 stock. I got a lot of positions in SMCI overnight because I didn't even have very big positions on, but now they're big.
Right, one contract became 10 contracts became 100 if you're doing options.
Yeah, I'm not even sure what I have on in there actually, but SMCI trading at $40.55. All right, Beth, let's do it. Let's go to the first slide. So we're going to talk about stock splits. So on October 1st, SMCI completed a 10-for-1 stock split, meaning the number of SMCI shares increased tenfold, while the value of each share was reduced by 1/10 of its pre-split value. The day before, SMCI stock price was trading near 416. After the split, the new stock price would be 41.6. If an investor had one share of SMCI before the split, their position would convert to 10 shares of SMCI worth 41.6. So no change. Your net lick doesn't change at all. You just have more shares of stock. Let's go to the next slide. This is all stuff you already know. So why do companies split their stock, and how does it impact investors? Here are the reasons. First, companies like to make their stock more affordable so that more people can play. A lower share price can make the stock more accessible to smaller investors who may not have been able to afford to buy it before. It improves liquidity in the underlying. No question that more people can trade it. It's easier to trade. Obviously, the option markets get tighter, everything. And it's a signal of confidence. A stock split can signal management's confidence in the company's current and future performance. And by the way, a reverse stock split is the exact opposite. When stocks get too cheap, they want to make them more expensive. And so they do a reverse split and reduce the number of outstanding shares. When stocks get too expensive, they do a traditional stock split where they increase the number of shares. Let's go to the next slide. This year, SMCI stock reached $1,200 at one point, almost 6 times higher than the average price the year before. This could have been one motivation for the company to conduct a split. I'm sure it was. When they were talking about it, I'm sure the stock was a lot higher. Let's go to the next slide. So here are the top 5 most anticipated stock splits this year. The most common stock split ratio is 2-to-1 and 5-to-1, but because these stock prices are so high, the ratio has been adjusted to 10-to-1 or higher. NVIDIA did a 10-for-1 split. CMG did a 50-for-1 split. ABGO, a 10-for-1 split, Walmart a 3-for-1, and LRCX a 10-for-1 on October 2nd, which is today. And so then you can see the post-split performance. Walmart's been up big, ABGO's been basically unchanged, so is NVIDIA, and CMG's been down 12%. So there isn't any, it doesn't mean they're going up, doesn't mean they're going down, it's just, it doesn't mean it's a lock that they're going higher, let's put it that way.
Sure.
But it also doesn't mean that they're crashing and burning because ABGO and NVIDIA are about unchanged. CMG's down, Walmart's up. Okay, and we'll see what happens in LRCX and SMCI. Let's go to the next slide.
So no real tell there, no real play.
No real tell. Since the beginning of the year, the SPX has surged 20%, outperforming most of the split stocks. For instance, NVIDIA's stock price increased by 240% in 23, but has only marginally moved since the split. This raises the question, does a stock split really boost the price upward? Let's go to the next slide. The data shows that a stock split doesn't necessarily guarantee better returns than simply holding the SPX within a year. And the volatility of the individual stocks is often much higher. And you can see here we have the SPX and we have the individual stocks and the SPX, and we can look at their returns, you know, and also the volatility. And the volatility in the underlyings, the SPX has much lower volatility than the individual stocks, and the returns are equal, if not greater, in the SPX. So it'd be hard to argue for going the individual stock route post-split compared to just buying the index outright. Let's go next slide. The index outright, just so much better in this case. Now let's take a look at Apple. Apple's had 3 splits since 2000. We recorded the performance for the 12 months directly after each split and compared it to the average performance of randomly selecting 12-month periods. Let's see Apple against itself. Let's go to the next slide. So like some other stocks, Apple yielded a positive return, averaging 10% in the 12 months following the stock split. However, it had an even better performance during the randomly selected periods of the same length. I think this is the most interesting, one of the most interesting slides of them all. So if you take the 12 months following the splits, Apple is up almost 10%. But if you randomly select any 12-month period in the last, whatever it was, 20 years, you end up with a 38% return in Apple. So yeah, this is what we mean by there's nothing predictable about this. You just don't know. Randomly selecting 12 months worked out better. Let's go next slide. These observations tell us that while the initial signaling of a stock split is generally positive, it does not guarantee a better performance. Even if their returns the following months are positive, they should be compared to the stock's long-term average performance. Let's go to the last slide, Beth. So stock splits provide various benefits to retail traders, including more affordable stock price and better liquidity. They often send positive signals to the market as well. However, the action of stock splits does not necessarily indicate future performance. So, basically, a stock split a post-stock split is pretty random.
Yeah, for net outcome of what's going to happen.
Yeah.
But the other factors that they make there, buy true. I mean, look at SMCI. It had $3 and $4 wide markets, which would be 30 and 40 cent wide markets post-split. And if you look now at SMCI, the markets are 10 cents wide, and I'm sure we'll only get tighter than that. So it's the equivalent of being $1 wide post-split. I mean, that's significant for a retail investor to look to trade.
Totally agree.
Let's take a quick 90-second break and come back. We got more Tasty Live after this with the moment you've been waiting for, the opening bell. We'll be back in 90 seconds. Tomas, we are back, my friend, but enough out of you. We've got this man, Jacob, in the house, the skinny on options. Matt, how are you, my friend?
Good morning, Tony. I am well. How about yourself on this fine day?
I'm doing great. No complaints.
Yeah, Chicago's still nice. You got a couple more weeks.
Oh my God, we're in the pool. It's October.
Yeah, it's perfect, right?
Yep, no complaints.
Excellent. Yeah, Chicago's got its good parts, and one of those is early October.
Yes, one of those early October, and then that's it. We're done.
Well, yeah. But enjoy it while it lasts.
I'm trying. Just like I'm going to enjoy this.
Yeah, you enjoy this, catch up on your emails, all the usual. But the people at home should hopefully get something good out of it. How you doing, Tom?
I'm perfect.
You there?
Very happy today.
Yeah, it's a good day for the good guys.
Not yet, but it will be.
All right.
I'm sensing.
Hope. You're sensing. Do you have an index with which to sense? Because today we're going to talk about how indexes can help us make predictions about the market, rather than your abstract sense and intuition. Yeah, let's get into it, Beth. If we can pull up our title, we're going to talk about skew and skewness today. So skew, S-K-E-W, all caps, is an index published by CBOE. Skewness is a property of random variables or distributions that expresses how asymmetric they are. And ideally these two things are going to be pretty tightly related, and they will be, but it's going to take us a while to get there and show this. But I can't see the slides, should I? Sorry, I can follow you. So skewness in theory, let's start there. I can't see where we are in the thing, but so after you have the mean, which is the expected value, and sort of expresses the center of mass of a distribution, right? Looking at the bottom, I've got 3 pictures of distributions. We've got their mode, which is just their single most likely value, labeled. The median, which is the 50% lies below, of the mass lies below, 50% of the mass lies above, and then the mean, which is the center of mass, right? Because while the median has 50% of the mass below and 50% of the mass above, mass that's further away from the mean pushes more heavily, right? You're trying to balance something on a point. And so the mean actually tracks that, right? The mean follows the tail compared to the median. And so when the mean is above the median, that's a positive skew, and the mean is below the median, that's a negative skew. Long ago, this was how the definition for skew ran. It was like the median it was the mean minus the median divided by the standard deviation. It's been sort of rigorized and brought into more standard mathematical language by making it the third moment, and has a very similar effect, but it's the third moment. So it's the expected value of the cube of the difference from the result to the mean in terms of standard deviation. So you divide by the standard deviation of the square root of the variance to get the total. And so the mean finds the center of mass. The variance or standard deviation describes how dispersed it is around that mean, and then skewness tells you how asymmetric it is. So that's the general concept. Let's look at how it applies to the market. Roll forward one, thank you. So these are some charts pulled from CBOE's initial white paper when they introduced the skew index. So it's all pretty outdated, but it's still relatively accurate. So while the Black-Scholes model has log returns of the SPX as normally distributed, the normal distribution is symmetric and has 0 skewness. Real-world market returns demonstrate a significantly heavier downside risk. So that's that left graph there, where the dark purple is just a perfectly average normal distribution graph, and then the orange is the actual realized S&P 1-month log returns. And so you see that it's got that sort of typical negative skewness picture where it's got this heavy tail, right? More results out, there aren't that many results way out to the negative side, but there's way more of them than there would be in that normal distribution, which totally vanishes over there. And then also those are balanced by a larger occurrence of things slightly above the mean, right? That those orange peaks over the center of the bulk, that shows that the most typical outcome is something slightly above the mean, but then it's balanced by a higher than normal outcome, representative outcomes for very far, multiple standard deviations below the mean, right? That if everything was normally distributed, then you'd say, oh, well, 3 standard deviations below the mean is only 0.5% likely to happen. We don't have to worry about that much. Everyone calm down. In reality, the market does go down by more than 3 standard deviations, not every day, but more than 1% of the time. And so this is seen in both the historical reality of these historical log returns and in a forward-looking way. If we look at the volatility smile, before 1987, no one really cared that much. They trusted Black-Scholes a great deal, and the volatility had a bit of a smile because further out of the money options were a little bit rich. Usually this was written up to something like rounding or discrete effects or hedging or something like that. The 1987 crash happens, everyone has to reevaluate where they perceive risk to be. All of a sudden, puts start being way more expensive than calls at the same distance from the money, and you get this smirk or this skewed, this much more steep volatility smile to the downside. So these are the 2 ways you can see that the real market does have this negative skewness, either by looking at its historical returns, log returns, or by looking ahead and checking the option prices and seeing the put skew in typical underlyings. So because of this, it then becomes interesting to try to measure how much skewness is in the market, because we use Black-Scholes for a lot of our underpinning mathematics, but we know that it's inaccurate, right? We know that, in fact, the market disagrees and historical returns disagree. They show a much heavier downside tail and put skew. So how do we try to express this in a single number just for people at home to use? And now we've got our hard slide. Is the next one? These are pictures. This is the mathematically dense slide. People can review it on their own time or not, or check out the CBOE skew white paper if they want. But I'll do a really heavy piece in like a month, going over, really dialing in on what's going on this slide. But I'll spare you that today. To give you the less dialed in version here, Tony.
I appreciate it.
So we'll let R be the 30-day log returns for SPX, mu its mean, and which is something like the risk-free rate timescaled, and sigma its standard deviation, which is something like the VIX or the volatility. And then we just do a little bit of algebra to expand out the skewness definition, and remembering that constants can come out of expectations, but cubings and squarings can't, and you get this term on the right. And now here's where the heavy math comes in. And this is the same heavy math that goes into the VIX construction. So if people want to see how it goes, they can check out some of our old skinnies. But so given an arbitrary strike availability, you can make an arbitrary piecewise linear payoff function as an option strategy. That's not that complicated, right? Options make flat and then a bend. If you scale them by a constant, you get flat and then a bend that's not one-to-one. If you then start adding them together, you can build them into different things. You can make a big sum of them and make sort of any graph that you make that's just all piecewise straight lines, you can build as a big option portfolio. It might be a goofy option portfolio to anyone to actually trade, but that doesn't matter. The point in theory is that you could construct it. And then piecewise linear functions, so we can now make any piecewise linear function, are dense in the space of continuous functions. So these continuous functions like r squared and r cubed are still approximable by piecewise linear functions, and therefore approximable by portfolios of options. And the way that those approximations work out is on the right-hand side here. R is the risk-free rate, T is 30 days, time till expiration. The sum is over the available strikes, and then the CBOE does the same trick they do for the VIX and say out till they find two zero bids, and then they stop looking just to save themselves computation time. KIs are the strikes. QKIs are the mid prices for the out the money options that strikes, or the average of the two at the monies if it's at the money. And then delta KI here is not delta in our Greek sense, but is delta in the displacement sense. It's the spacing between the strikes, right, which matters for the weighting. And then so this lets you construct the expected value of R, the expected value of R squared, and the expected value of R cubed, all as portfolios of options, right? Because they're option prices, those QKIs, times constants and put in a sum. And times constants is just how many of them you buy, put in a sum is combining them into a big portfolio. And so now we've got this incredibly messy looking portfolio, but it does this nice job of it's supposed to have its current value and the skewness should very closely align, right? There's a couple of approximations that go on. There's approximating arbitrary payoffs by linears. There's approximating using every available strike with every theoretical strike with all actually available strikes. And then there's, because it's all supposed to be 30 days, but reality doesn't always have 30-day options, there's a linear interpolation is done between near-term and next-term options. So, if it's 15 days and 45 days, it's 50-50. If it's 29 days and 59 days, it's almost all the 29-day and a little bit the 59-day price, but it's just a straight average. And so that gets you this big portfolio price S, which measures the skewness. We can go forward and get it out of here. Beth. So this process constructs a portfolio of options whose price by the efficient market hypothesis should very closely match the skewness of a 30-day log return SPX. Right, this is the whole algebraic rigmarole. CBOE looked at this and went and just plugged it in and went historically. Well, for one thing, we expect it to be negative, right? We've seen historically and input skew that we expect negative skewness in the market. And it's a pretty small number, right? 0 would be exactly normal distribution statistics, and between 1990 and 2010, it ranged between minus 4.69 and minus 0.1. So because traders don't like small negative numbers, they like big positive numbers, the CBOE does a pretty simple thing where they take, instead of using this portfolio S, they take 10 times it just to make it a bigger number, and then they subtract it from a cash account. Right, so then the actual skew index is 100 minus 10 times S. And so what this results in is an index where if it's 100, that would fit with market expecting 30-day log returns to be normally distributed, or at least symmetrically distributed. And that the higher it goes, the more put skew there is, the more the market is preparing for a downside move, sort of in excess of a normal distribution statistics. So the things to think about here are that, one, from 1990 to 2010, the skew index was never over 147. I think, Tony, if you look right now, it's like 160 or something.
Yeah, you are correct. The skew, 158 and change, but whatever, it floats, 159.
Yeah, right. And sort of in the past several years, it's sort of spiked up to around 180 and very rarely gone below 140, which is all to say that the market has sort of changed its perspective. I think sort of 2008 is around when the shift happens, where skew kind of went from being something that fluctuated between 100 and 150 to being something that more fluctuates between like 135 and 180. But this measures sort of how much you should expect downside statistics to be worth, and it's all EMH, right? It's all efficient market hypothesis. So it's not saying that anything is a bad idea or a good idea. It's saying it's based on the fact that the puts are expensive, saying that, well, if these puts are expensive, that means that the market is expecting, or is at least prepared for, a large downside move. And maybe this is a thing that I think sometimes people, right, even CBOE likes to talk about the VIX as a fear index, and I think that's maybe even backwards. Right, it's more of a preparedness index, right? When the skew is high, it's not because we are going to have a big downside move. It's because market participants are hedging against and preparing for large downside moves. It's maybe even like sort of the opposite of a fear index. It's a statement of like, well, everyone's ready for a possible big crash when the skew is really high. Not that a possible big crash is about to happen and everyone's afraid of it, but that everyone's sort of prepped, right? Their basements are full of canned food, things like that. So that's, I think, all we're going to cover today. That's the skew as it's constructed and skewness as it actually is for distributions and the relationship between the two of them, which is that 100 minus 10 times the skewness is the approximated relationship. Perfect. Let's do takeaways. Skewness, the third centered moment of a random variable, serves as a measure of asymmetry. Negative means the tail is heavy to the downside, and positive means it's got a heavy tail to the upside. The skew index is published by CBOE and follows a very similar methodology to the VIX, right? The actual papers that construct it use all the same references. Approximating skew, rather than approximating the volatility, approximates the skewness by using market prices for a carefully constructed basket of at the money and out of the money SPX options. In practice, the skew index is approximately equal to 100 minus 10 times the skewness. And remember that skewness is negative, so minus 10 times it is adding something. So larger skew means a heavier downside tail. 100 would fit with normally distributed log returns. When skew was first released, it never had data outside of 100 to 150. Nowadays, seeing it down to 100 would be bizarre, and seeing it up to 180 is not. I mean, 180 was like where it spiked during the pandemic crash and such. But that's sort of its upper range these days, and things sort of change. By being mindful of skew, right, when we're deciding how to trade our options, we can always check on the skew index and see where the market participants are prepared for downside black swan moves, right? That these black swans that are never supposed to happen, in fact, do happen, and people are now prepared for them, right? By trading heavily in these far out of the money put options is really what's happening. That's what really drives up the price of the skewness, or the skew index, right? Drops the skewness, drives up the skew index, and gives us this nice reading. But I think in terms of people's actual day-to-day trading, the thing to recognize is that the efficient market hypothesis says that the options are fairly priced, and that if you're using the standard deviation to sort of place your strikes out there, this is a good call. But when skew is really high, you shouldn't think that 2 standard deviations is like 5% safe, and 3 standard deviations is 1% safe. Those are sort of your normal distribution statistics. But the higher the skew index is, the further away from normal distribution statistics we are, and the more the market's prepared for a big downside move. And so the more you should be prepared for a big downside move. Not afraid of, but prepared for.
So, what do you think about preparation? You're a prepper.
So I'm not a prepper, but that's a weird, I wish we had that definition before, because it makes sense. Whenever the skew's high, we never seem to crash. We always seem to, it always seems to have the biggest, most violent down moves when the skew is really low. Yeah, I never thought of it in terms of that's really more of a reflection of how the market is prepared for that event than it is for that event to actually, like, we always looked at it as that, okay, this means that they're buying a lot of protection because they're scared. But the reality is it just means the market's way more prepared for it than at any other time.
Yeah, right. And the other thing is that, right, even when skew is really high, it's not saying that a big downside move is super likely. It's saying that instead of 0.01% to have a, you know, a huge, like a 4x standard deviation downside move, it's like maybe 2%, right? 2% is many times greater risk than, you know, your 0.1%, but it's still a pretty unlikely thing to have happen.
Yeah, no, that's good. But just a reflection of preparedness for that kind of event is a better way of explaining skew. Totally agree.
Yeah, especially the skew index, I think.
Yeah.
Good stuff.
Good job out of you. You know what? I'm going to let you go. We're going to take a quick 90-second break. NASDAQ just turned green, South. We'll be back in 90 seconds with, oh, joy, your friend of mine, Mr. Scott Sheridan, followed by Johnny Trades.
Fun.
Oh, yeah. It is Wednesday, October 2nd, a little bit after 5 p.m. Central. You know what that means. It's time for Tasty Live's evening show. Tasty Live's evening show, a little podcast called The Price of Truth. The podcast where we explore the incentives that govern our world. The idea is simple, my friends. Have great ideas. Come on and share great. Excuse me. Let me say that again. The idea is simple, my friends. Have great minds. Come on and share great ideas. Today we have with us one of the best minds here at Tasty Live, global head of macro, the one, the only, Ilya Spivak. Ilya, how you doing? Welcome to our first 90-minute conversation since, 2 years ago.
At least first 90-minute on air. You and I have gone plenty longer than that off camera.
Fair point.
And that we would be able to do were they to let us, but they do have to put us back in the box at some point. I'm good. I like what these markets are setting up for this week, and it'll be interesting to see how it all resolves. The next 48 hours should be mighty interesting.
Yeah, I shouted you out yesterday. At the end of the episode, I said somewhere out there, Ilya Spivak's got a big smile on his face.
That's right.
Given what happened in markets yesterday, we'll talk about that and much, much more. But before we do, let's say what's up to the people. Shout out to everybody watching on tastylive.com. Head on over there if you'd like to check out. Tasty Live's got a bunch of other stuff besides just the content we do here. A bunch of other learning tools. Ilya, my man, is writing a bunch of content as well as other content creators. So there's a bunch more going on here than what you see on YouTube. Make sure you head on over there and check it out. Shout out to everybody watching on Tasty Trade desktop and mobile applications. If you don't have both of them, you should probably go and get them. But if you want to be part of the conversation, and the producers are going to throw up this chat on screen, and if you want your name and comments to be on the screen, there's only one place that you can do that, and that's over on the evil Google YouTube. So head on over to YouTube, type in Tasty Live. Click on the live tab. You'll find my big inflamed head somewhere on a big red thumbnail. Jump in and introduce yourself. Everybody that's in the chat right now, you know what to do. Let's start spoofing that Google algorithm. Say whatever you want. Tell us your name. Tell us where you're from. Just type in random ass characters so we can spoof the Google algorithm into placing us in front of as many people as possible, and we can save the world one view at a time. My good friend Ilya Spivak, there's nothing left to do but to do it, my friend. I'm going to